Good morning. Good morning, ladies and gentlemen. We'll use about less than a minute, if we can, to find our seats. Just less than a minute for a bit of order for us to find our seats, ladies and gentlemen. All right, as the last few people find their seats, good morning, ladies and gentlemen. Just to see that we're all alive and we're here, good morning. Fantastic. Msime Kabura, and for the next 2 days, I'll be the most familiar face you see. I'll be your host for the banking or the Bankers Conference for 2022. It would be unfair to start any day without the Most High. So allow me to, before I actually do that, pucker up, faces on, because we're live on NTV. So, and we're also live for the team online. So anything you say will be used against you. Please welcome the Executive Director for the Uganda Bankers Association, Mr. Wilbrod Award, to give us a prayer, and so we can kickstart. I guess it's his blessings that will take us into these next 2 days. Wilbrod, we're Africans, we... wonderful.
Recording in progress.
Thank you very much. Let us humble ourselves in prayer. Heavenly Father, thank you very much for the gift of life. Thank you for the gift of the journey mercies that have enabled all our guests to assemble this morning. Thank you, Father, for the responsibilities that you have entrusted us with. Join us this morning, Father. Join us in our deliberations so that in all our discussions, Father, you help us shape those much needed interventions to enable our economy recover post-2021, post-COVID, and give us the courage as leaders to see through our various recommendations, reforms, interventions, so that our people, our country, our region recovers. As Christians, we depend on you. We have come this far because of you. Help us in these tough times. We ask all this through Christ our Lord. Amen.
Listen, mediating between us and God is a hard job. Thank you so much. Once again, good morning. I'm Flavia Tumsime Kabura, and I will be your host for today and tomorrow, these next 2 days. Our hashtag is Bankers Conference 2022. If you're online, we do have a team that will be joining us that is not physically here, that are joining online on Zoom, on the links, and we're also live on NTV Uganda throughout this morning, because this is a very important conversation. This is the 5th Bankers Conference. It's the first for me, but I'm excited to be part of the dialogue, which is bridging the gaps. This is a solution-centered conversation because we don't want to just talk. I do that for a living. It doesn't get us anywhere. But you're in the room because you're very, very important. You are the people who are not just giving finance or to make sure that there's funding for certain opportunities. We're talking about manufacturing, we're talking about tourism, and agribusiness. If we claim that we're a country that is centered around agriculture and it's feeding most of our people, then we definitely need to innovate. We need to get beyond just a conversation around rudimentary tools to how we can innovate for it to be much bigger. Apologies, ladies and gentlemen. We forgot the most important thing of the day. of course, prayer was the most important thing of the day. But can you imagine that we'll be discussing recovery for a country like Uganda and not be patriotic enough to sing the national anthem? Would you be kind to get on your feet for that? Thank you. Patriotism first. I don't know if the team is able to find for me, so we can at least have the stanzas as protocol is observed. Thank you. I believe typically we should have the East African at least play. Please, thank you. If it doesn't start, I will sing. Rescue us. I also believe in timekeeping. Who votes that we sit in respect? Aye? Great. Thank you so much, ladies and gentlemen. I think part of being a host for any event, especially with such caliber of people, is to know what to do. So I think I've done well so far. Thank you so much for that note. So ladies and gentlemen, again, welcome. I see some new faces, so we'll redo it. I'm Flavia Tumsime Kabura, and for the next 2 days, I'm your host. We'll have a series of conversation because this is not just about talking, like I was saying and emphasizing. We're solution-centered, which means we don't just talk, we actually find the answers. What next? We've been talking about recovery, and I mean, you've seen the mishap. We're used to online conversations and online events. It's a bit rusty on the protocol when you come for physical events. So now you can imagine when industries are restarting and recovering, who pays the cost? What does it look like in recovery? It's 2022, years after. Even if it's not miles and miles of years after, COVID-19 and its effects, they're going to be felt for a very long time. As they say in banking, it's going to get worse before it gets better. So we trust that you're the right people in this room to have these conversations because you're at the helm. Either you are giving or you are taking. So we're talking about the people who are coming to innovate in their industries. We've got gatekeepers of certain sectors who are here. We've got regulators in this room. We've got bankers. Of course, this is hosted by the Uganda Bankers Association. We also have our co-host, who's also our watchdog and our body, which is Bank of Uganda. Actually, we will be recognizing our guest of honor, who is the Deputy Governor for Bank of Uganda, Dr. Michael Atingi Engo, who will be joining us. But first, just to get the day started, like I said, time is a favorite for me, so we'd like to catch up for the day. Please welcome my first speaker of the day, who will have the honor of opening our event, but also the honor of then inviting the permanent secretary at that point. Please welcome the chairperson of the Uganda Bankers Association, Ms. Sarah Arapta. Please, thank you.
Time is indeed a favorite for all of us, Flavia. The Deputy Governor, Bank of Uganda, Dr. Michael Atingi Ego, Honorable Members of Parliament here present, Permanent Secretaries, Ministry of Trade, Industry and Tourism and Antiquities, respectively, the Chairman, Uganda Manufacturers Association and Uganda Tourism Association, the representatives of MasterCard Sub-Saharan Africa and ABI Finance, respectively, our keynote speakers, distinguished panelists, authors, resource persons, and sponsors of this conference, members of the Diplomatic Corps, development partners here present, all representatives of government ministries, departments, and agencies, stakeholders in the manufacturing, tourism, hospitality, and agribusiness sectors, other private sector players represented here this morning, representatives from the academia, civil society, and all professional bodies, directors and chief executives, officers of financial institutions, distinguished invited guests online, ladies and gentlemen. My name is Sarah Arapta, the CEO of Citibank Uganda, and also UBA Chair as introduced. On behalf of the Uganda Bankers Association, I thank you all for honoring our invitation, and I welcome you to the 5th Annual Bankers Conference being held today and tomorrow. This year's Annual Bankers Conference comes at a time when Uganda was beginning to recover and live with the impact of the COVID-19 pandemic, following the reopening of our economy in February. And just as the wounds and scars of the pandemic disruptions were healing, with projections of a rebound in economic activity, a sunset of economic uncertainty suddenly shed a dim reality to this expectation. The second quarter of 2022 brought with it significant downside surprises. The scale and magnitude of the global economic uncertainty rising from the war between Russia and Ukraine has impacted global financial markets and commodity prices, coupled with the inflationary wave on a global scale. We are part of a global village, and the impact of the war between Russia and Ukraine has caught up with us through the supply chain disruptions, commodity price spikes, especially fuel, food insecurity, a drought we're seeing in Uganda now. These are all now compounding inflationary pressures. With the outlook remaining uncertain, access to international capital markets is fraught, with tightening from Western economies who are raising their central bank rates. Many African governments are struggling to respond given the limited fiscal space they are faced with as they strive to overcome pressures of debt servicing given the tightening of financial conditions. It is with this backdrop of such challenging times that we must stand up and be counted as finding sustainable and resilient solutions that will address our own challenges domestically and regionally. Ladies and gentlemen, the theme for this year's conference, Bridging Financing Gaps in the Manufacturing and Tourism, Hospitality and Agribusiness Sectors to Catalyze Economic Recovery and Growth Post-2021, is therefore very relevant during these very unprecedented times and presents both challenges and opportunities, as well as not only for the financial sector, but other related sectors and spheres in life. Our National Development Plan, NDP3, highlights, amongst others, manufacturing and tourism as key growth sectors that have huge development multiplier effects owing to the forward and backward linkages and related value chains, including agriculture, the SMEs and job creation in regional trade and generation of foreign exchange, and as such, considered priority areas of focus. Manufacturing is a key engine in Uganda, given its very strong linkages and spillover effects in the sector. The banking and financial sector is therefore pivotal to all the above dynamics as providers and enablers of financial flows, and is the reason for this year's annual Bankers Conference dialogue. The banking sector continues to carry a direct exposure of about Uganda shillings 2.4 trillion to the manufacturing sector, excluding indirect facilities like guarantees and letters of credit. That are to the tune of about 435 billion, and also indirect working capital facilities to the tourism sector, while tourism property developments are captured under commercial and real estate. For a country to expand, financial flows to these sectors need to be scaled, and by extension, their multiplier effects will come into play. Ladies and gentlemen, during this conference, we will, amongst others, take stock of the financing gaps and other funding challenges therein constraining the manufacturing, tourism and hospitality and agribusiness sectors in accessing financing, and most importantly, how to ready our borrowers in these sectors and to ensure that the different types and combinations of financing are taken up. The conference will also evaluate how best financial sectors and institutions can competitively and sustainably bridge these gaps and make available the much-needed financing required to support recovery and growth of the above two sectors without compromising resilience and growth of the banking sector itself. Funding goes hand in hand with expansion of markets, which is where the cash flows come from. Support towards access to and opening of markets, especially around the region, as well as attracting of more visitors as we build capacity, will therefore be very critical anchor pins of a sustainable funding strategy. We accordingly need to, amongst others, review fiscal policies that ascertain inflow of private capital, be it debt or equity. We need fast-track legislation that enables the banking and financial sector to expand and deepen. We also need to ensure that we cultivate good borrowing and a repayment culture to attract more finance providers, and also take into account ESG matters that are now central to the flow and sustainability of any business. For this to happen, the economy relies on policymakers, legislators, private sector players, and indeed all of us. Ladies and gentlemen, I'd like to use this opportunity to intimate to government and the private sector players, particularly the manufacturers who are today's dedicated audience, that the banking sector are your key partners, and beyond the custodial, tax collection, payment, facilitation and extension of credit roles we play, including to government through investment in government securities, as well as provision of infrastructure financing, support through trade services. We are, and I would like to really emphasize this, we are currently working on a specially structured and customized regional export credit facility to the tune of Uganda shillings 1 trillion to support our manufacturers involved in regional export. We plan to have this export credit facility launched later this year by His Excellency, the President of Uganda. Uganda not only has comparative advantage in agriculture and natural resources, but is equally endowed with critical factors of production like land, skilled labor, and electricity. So the objective here is to really plug the existing gaps, facilitate production, provide funding support to the catalytic and powerful entrepreneurial ecosystem through fostering, amongst others, technology innovation for enhanced value addition to drive export growth and fully harness the attendant trickle-down benefits. Ladies and gentlemen, today we will hear from various conference resource persons who have graced our conference. In a special way, allow me to welcome our keynote speaker, who will be introduced in more detail. Mr. Fofak and Mr. Louise, we thank you both for accepting to come and share with us your insights on the theme of this conference. I'd like to convey our sincere gratitude to the Deputy Governor and his entire team at Bank of Uganda for the continued stewardship of the sector, particularly in these challenging and evolving times. Special recognition goes to government through the Ministries of Trade and Industry, Tourism and Antiquities, the Ministry of Finance, and all its various agencies for the important role they play in this journey. To you all our sponsors and partners, including MasterCard and ABI Finance, I say thank you very much. Asante sana. I would also like to thank the panelists, writers, all stakeholders and participants who have logged on and are participating online for coming to share your knowledge, insights, experiences, above all, hope. And importantly, I'd like to thank the UBS Secretariat under the stewardship of the ED, Wilbro Dewar, and your team. Thank you for putting this together. I wish to conclude by saying that as a sector, we're fully cognizant of the delicate balance between facilitating growth and at the same time remaining resilient as a sector, especially in these challenging times. Critical to this resilience is the demonstration of the role that we play in embedding sustainability in every aspect of our mandate. Looking ahead, sustainability will be an even more integral part of not only what we offer for our borrowers as they access capital, but crucially, a basis for us to challenge ourselves on how to fully and sustainably unleash the sector's full potential for supporting national and economic social transformation of Uganda. We therefore count on your continued support in bringing alive all the recommendations that will arise from this conference as we foster economic recovery. I thank you all.
I might have neglected to say something extremely important. I'm going to ask Sarah to stand here because it's a very important note. Did you know that this is the first female chair of UBA? I mean, put her extensive years of experience and everything aside, congratulations. Thank you for getting the ceiling and just throwing it out. In a few minutes, I'll be calling you back to give us the honor of calling our permanent secretary, but I'll let you sit for a bit. A big thank you to our sponsors. Yes, by the way. You can't talk inclusion and not throw a round of applause for such things. Ladies and gentlemen, our sponsors, we want to thank Rugzio, the data setter company, who've actually made it possible for us to be here. A big thank you to Finca. We've got BPC, Afri-Exim Bank, MasterCard, who will actually be having a couple of conversations today. We'll also like to thank, of course, our co-host, BOU. We'd like to take eyes to the screen, wherever you can look, for something.
Economies across the world plunged into deep contractions in 2020, no thanks to COVID-19. There wasn't one industry unaffected. Manufacturing, and most especially tourism, were no exception. For Uganda, the disruption to manufacturing caused severe operational, social, and financial consequences. For tourism, tourist arrivals and forex earnings dropped greatly. But what can key primary growth sectors of an entire country do when they're shaken up by a health crisis? They adopt, they survive, revive, and they must dare to thrive. But to thrive, sectors require timely and tailored financial support to anchor their recovery and growth. And there's no sector better placed to take center stage and steer their recovery than the banking sector. Now is the time for us to redefine our role as the backbone of our nation's economic recovery. This year, we discuss how best we can begin bridging financial gaps in the manufacturing, tourism, and agribusiness sectors to catalyze economic recovery and growth post-2021. Ladies and gentlemen, welcome to the 5th Annual Bankers Conference 2022.
Just remind you that we are live online and on NTV Uganda. We'll also have a hashtag. It's actually BankingConf22 conference, but short of it. So it's BankingConf22. We're on Twitter and all the other platforms. Allow me to now welcome the chairman for the Uganda Manufacturers Association to give us a few words. Mr. Deo Kayemba, please join us. Welcome, therefore.
Good morning. First off, just to say Mr. Deo Kayemba looks different from me. My name is Daniel Berungi. I'm the Executive Director of the Uganda Manufacturers Association, and I'm very glad to be here. The Chairman, Uganda Bankers Association, the Permanent Secretaries of the Ministry of Trade, Industry and Cooperative, our mother ministry, and the Ministry of Tourism, Wildlife and Antiquities, the Deputy Governor, Bank of Uganda, distinguished guests, ladies and gentlemen. First off, allow me to congratulate the Uganda Bankers Association on holding yet another Bankers Conference, and to hold it in a period where we are speaking about recovery and to theme it appropriately is also something worth celebrating. As manufacturers, we certainly have a long relationship with the banking sector. This relationship has birthed a number of the big names that we see in the economy today. And for that, the manufacturing community is very grateful to the Bankers Association and the members therefrom for the support that we've gotten thus far. Of course, talking about that, we can't also go ahead without speaking about the discussions we've had in the period post-COVID around recovery support, around deferral of payments, and for these, I believe that you deserve a hand clap for coming out to support the manufacturing sector through the last 2.5 years that were pretty much unexpected on all sides. Of course, we are also cognizant of the fact that the sector is understanding the needs of the manufacturers. Madam Chairperson, the discussion on the export credit facility is a particularly welcome discussion because this is a discussion we've been having for quite a while. We are definitely grateful that this conversation has taken fruit and that we are now at the cusp of launching something that we believe as manufacturers is a game changer in terms of access to the region, in terms of access to the African Continental Free Trade Area. Ladies and gentlemen, while preparing for this, we thought about 3 areas that we thought would highlight today for the bankers to appreciate in as far as manufacturing is concerned. And these 3 areas, in our mind, are critical in enabling recovery, and with reference to the theme, in enabling the addressing of the gaps that we see existing in terms of financing for manufacturing. The first area would be the area of affordable and long-term financing. And I believe that it is a conversation that we've had for quite a while. We can see that you're beginning to move to listen to this. And it goes without saying, really, that as we speak NDP 3, as we speak to the fact that we are moving to import replacement as a nation, we then get into an area where we have to invest in things like iron ore processing. Now, for iron ore processing, everyone will tell you that getting a commercial bank loan with a tenor of 3 to 5 years is laughable in that case, because there is no way you're going to set up and start effectively processing your iron ore in 3 years. You need 10 years as a bare minimum to even start thinking of sustainability of this. If you talk about textiles, if you're putting up a spinning mill, a textile mill, a fully integrated textile mill, these are the periods we are looking at. And so I hope that today we can, through the conversations we are going to have, also appreciate where the challenges are to the reduction in pricing of these term sheets, but as well to the tenors that are usually available. The argument I've often heard said, and I'm glad the Deputy Governor is here, has been around the fact that with the appetite of government where it is, it becomes easier for me as a commercial bank to lend to government through treasury bills, because they are reliable, they are available, and I can sit back and wait. Little wonder, therefore, that I'm sure that all the CEOs in here are smiling, because post-declaration of results, I've read the results, and you people are doing well. You should clap for yourself. It's good times to be a banker. But as we speak to that, I think from our end, the conversation is, how do we ensure that it's sustainable, that these bonuses are sustainable on your end? And in our mind, sustainability of these bonuses lies heavily in being able to stimulate the sectors that can deliver to you sustainable profits. And we believe that these are in the areas of sustainable manufacturing, long-term manufacturing, discussions on iron ore, textile, and other deep value chains, because these are the ones that can deliver what we are looking for. That's number one. Number two would be the issue of pipeline development. I've had several discussions with several bankers, and our discussions have always been to say that we have to get our hands dirty as bankers and get involved in the process of preparing the people who are coming to us to borrow. I'm glad that members of the Bankers Association have taken this call up. We've seen several bankers and banking agencies setting up incubation centers, SME development hubs, and we congratulate you and applaud you for that. However, like Oliver Twist, we want more. We want you to walk along with us every step of the way as we develop the capacity to grow our businesses. Because from where we sit, it's a win-win situation. Once the SME grows, you as a banker grows. For the names that we see today in the sector, the roofings of this world, the steel and tubes of this world, what did these start out as? They started out as SMEs that were struggling to make ends meet. But today, I'm certain each of the CEOs here would quickly run to attend a meeting with them if they promise to switch their accounts to you. And we are saying, walk with us to support these SMEs to grow so that you can then reap the benefit as we go along. Third would be the area of export development. And Madam Chair, I think One is to, like I already said, say thank you that the export credit facility is finally coming to fruition. Ours is to say that there is also more that can be done in terms of support to export development. We are in a situation where we have a captive market in the DRC, with several of the products that we produce here able to competitively access that market. The average challenge still remains that the people trying to take these products there cannot access affordable credit to take it there. But relatedly, you have the possibility of leveraging your international networks to support in the areas of, for example, access to machinery for small-scale manufacturing. If you have a link bank in China, why should a manufacturer in Uganda have to fly to China to check on the viability of a supplier? Can this be something that is offered within the banking circles? Because then it's a case of you leveraging your international footprint to be able to access some of these facilities. Relatedly, we also need more of you to move into some of the markets that we are going into. We're talking DRC, but what is the footprint of banking, especially Ugandan banking, in the DRC? It's not that big, and I think there's scope for entry there and scope for support. On that note, I wish to also say that it's not all doom and gloom. I was told to be candid, and I've been candid, but I also wish to say that we are definitely grateful for the journey we've walked thus far with the Bankers Association. There is a lot that we've been able to achieve as a result of the support of each and every one of you in this room. And as the manufacturing sector, we salute you, we pledge to continue working with you, and we hope that we can come here next year and look at the results of the discussions from today and celebrate to say we've actually moved forward. Thank you very much, and I wish you fruitful deliberations.
Thank you so much, Daniel Birungi, the Executive Director of Uganda Manufacturers Association. Delighted to see you. I think we got a better bargain because you made lots of great notes. And what stands out there is that they want more. Gone are the times where a bank is just, will give you money, will fund your dreams. My dreams are bigger than that, and you have to understand that. You have to understand the value addition I need to bring to the markets. You also need to understand what he just said. You're not competing domestically, regionally, yes, but also globally. So how can a bank help me get everything from access, the networks he's talking about, help me add value to what I am doing? And these are the conversations to be had today. Allow me to welcome back the chairperson for the Uganda Bankers Association to help us then invite the permanent secretary in the Ministry of Trade, Industry and Cooperatives. Ms. Sarah, please.
Thank you, Flavia. It's my distinct honor and pleasure to invite the PSST, Dr. Gobi. You're most welcome. My sincere apologies. I completely got that wrong. My distinct honor to invite Permanent Secretary, Ministry of Trade, Industry and Antiquities. You're most welcome, Geraldine Sally.
Good morning, ladies and gentlemen. If I start mentioning titles here, I might be got for it because I can see very many people in the room who are really high up there. And first of all, the table they've put me, I found a whole governor there, and I'm already humbled by the fact that the people in the room are top-notch, so all protocols observed. So good morning, ladies and gentlemen. You'll forgive me, last week I lost my voice, so today is the first time I speak since I gained it back, so it might be hoarse here and there, but kindly bear with me. I'm from the Ministry of Trade, Industry and Cooperatives. In Luganda, I have always said it is ekitongole ndi muwandiisi w'enkalakalira mu kitongole eky'amakolero eky'abasuubuzi n'ebibiina eby'obwegasi. So some people really understand that the way it is. Kubanga I am ndi muzzukulu wa Mugema. So that is the emphasis of the matter. MTIC is mandated to formulate and review and support policies, strategies, plans, programs all throughout government to ensure the expansion of diversification of trade, cooperatives, and environmentally sustainable industrialization. Many of you will understand that when I say environmentally sustainable industrialization. Appropriate technologies to develop and transfer and generate wealth across our country for us to properly become middle income status and beyond. For us, that is simply our constitutional mandate. As government, we cannot do much without private sector. And I'm so glad that you have critically themed this Bankers Association conference around bridging financing gaps in the manufacturing, tourism sectors to catalyze economic recovery. The tourism sector, as well as manufacturing, trade, and the cooperatives are the biggest GDP earners of the country because they account for about 28%. And, you know, if you add them all together, they are actually driving the economy fundamentally. But again, sadly, they are underfunded, and that is a fact. And here, I am here to speak facts. I'm not going to gloss over anything, and at least people know that I speak facts. So in terms of driving the programs of government under those very sectors, the financing is limited. And that is why it is very critical that we are here today for the private sector to help government push all these things forward. So for me, so I would like to thank Mr. Wilbrod and his entire team for choosing this very topic. And I'm going to leave you with just two major things. And the two major things that I would like to leave you, after you have scripted this very well, is one, actual financing in the manufacturing, the actual financing that is required. Those are then also financing gaps that can be bridged and the required financial inclusion of small to medium enterprises to catalyze economic recovery and growth post-2021 COVID for the financial institutions. But before I go into the two issues in depth, I would like to say we need to scale. We need to scale on everything that we do on those 2 points. Why do we need to scale? Because we will have so many symposiums on an annual basis. There will be very many conferences within Nairobi, Tanzania, Arusha. Everybody is talking about financial inclusion. We know everything. We know our problems. We know that there is expensive financing in the private sector. We know that. Uganda is the place where every document on development is written and these things are implemented in other countries. We are brilliant people. We write theses, we write consultancy papers, we write reports. But the lacking bit is the part of implementation. I do not want to go away from this conference without the assurance of the members in this room that we shall have outcomes from this two-day symposium, which we shall leave you to deliberate, but at the same time, we shall have a report like a cabinet paper which we can take away as feedback from the private sector to government on how we can actually implement. And I'm hoping that there will be a team that is formed to go away and highlight the key issues, the key deliverables, so that every party and stakeholder included is included, and every responsible party is given their timelines and deliverables on exactly what we need to get out of this conference. Otherwise, we may not turn up next year. For me, I don't want to invest my time in conferences which do not deliver what we intend to do. But I know that there's a lot of money in this room. That's all I know, and that's why I came. So, actual financing gaps. Mr. Deo Kayemba has already mentioned. So the systematic presence of financial institutions and their smooth functioning is very critical for all these programs. And indeed, we are cognizant of their central contribution over the years for implementing government programs and all the financial systems that have been crafted to deliver on the same. Many of you have been singing this song of Parish Development Model, have been singing the song on NDP 3 Millennium Goals, have been singing the songs of sustainable development and all those things that go with it. But we also need the money to back it up. The good news is that we already have evidence that the banking sector is in there. But how they are in there is what really matters. So on the first thing, when I'm talking about financing gaps, let me just give Uganda status at the moment. So currently we have all the domestic investments that are happening. We have the Uganda Investments Authority, we have UDC, all these people are delivering, but really it is not sufficient. If you look at the percentages, they are not sufficient. So delivery on promised NDP 3 government goals is limited unless we have about minimum of the 16% GDP which is contributed by manufacturing alone. So if we can propel manufacturing in a way that helps us on the gaps where we are talking about import substitution and export promotion, just think about the funding gap being geared towards just those two things. And I wanted to give just one example that happened in Uganda 5 years ago and then left us and went to Tanzania. I have given that example to Mr. Wilbrod already, but I'm going to share it with you for the benefit. When Tanzania realized that they need food security, they went out and just decided to do one item on food security. They didn't do much. They just decided we shall do rice. So they organized themselves in such a way that they can look for resources to do rice as food security in Africa. But the people who went to Tanzania to do rice started here in Uganda. They came in from Norway and other European countries. It was a team of people from European Union and private sector. They docked in one of our hotels here at Golf Course and started engaging government agencies, MDAs, and all the people who are involved in production. So as it all happens, they promised them that they would take them to State House. For 5 years, that did not happen. Because you cannot invest in this country if you haven't got the blessings of the top office. So they went round in circles until they were frustrated to the extent that they left. Now when they left, they actually found the banking sector in Tanzania ready. They found the banking sector ready to mobilize resources to implement exactly what failed to be implemented in Uganda. And why they had chosen Uganda is because they were told we have one of the most fertile soils in Africa. So they left, but they were willing to even put in fertilizer, even if the soil was bad. But what happened is that they were led by Exim Bank, together with all the other banks. They put resources together and they went deep into the value chain of rice. And today, they are the biggest producers of rice in Africa. Madagascar follows, and they are feeding South Africa, they are feeding the whole continent on rice. And that is why you hear the story about rice coming in from Tanzania to beat the local production of rice in Uganda. They have gone into scale as well. So you as bankers can also choose some of the big items. If you see URA has about 15 items for which are candidate for import substitution. One of them is coffee. And the statistics can come in later. But as you know, Uganda left the International Coffee Organization. So we have an opportunity to sell our own coffee and go big on coffee because we know that it will fetch very high prices in Europe. We are not coffee drinkers, we are coffee producers traditionally, and it's one of our biggest cash crops. But we have not invested in that value chain that deep. So if we choose one of those, I can assure you, we have got orders from China, which I don't even want to talk about because I know that we cannot fulfill the market of China. We are talking about 73 billion people, and they have placed orders for coffee, they have placed orders for sim-sim, they have placed orders for shea butter, and they have placed orders for maize. I have not responded because I don't have the scale and quality of production to feed the Chinese market. But I know that if the bankers in Uganda are organized, and by the way, there is a lot of room for everybody. Right now is the best opportunity for bankers to come together and tap into these markets because there is money to be made everywhere. There is no time for competition. Competition is really secondary right now because there's a bigger goal to get on the bigger markets. People talk about DRC. DRC market is too big. When they started placing orders here for fish, we are looking for fish. We can't even give them fish. They want fertilizers. We went, we did the negotiations with them. We signed all the MOUs and everything in DRC. Congratulations to Equity Bank. They have their footprint in there first. I think other banks will follow and provide services, but the most important thing is provide and tailor products that can actually service these sectors effectively. Right now, we have very expensive financing on the market, which is insufficient for driving production. So for me, if we go away and I take you back to the production, if we can say the top 10 or 15 products and services that we are importing and we want to do import substitution and produce them locally. We have petroleum products and everything that goes with it, iron and steel. You know we have a lot of steel in Kabale and Chibale, tons and tons of steel, but we are importing steel because they are saying that the quality of steel we produce is not good. So we are doing all these dams, infrastructures and roads with imported steel. So it's one of the biggest items we are importing, yet we actually have steel in Uganda. Veterinary drugs, all these farms that you see with very big expanses of cattle, pigs, what you name it, we have to import all the drugs. We do not have the facilities to produce all these drugs. Cereals. Imagine we actually import a lot of cereal in Uganda, yet we have the northern part of Uganda with a lot of free land where we can actually develop the value chains on cereal and grain. Plastics, vegetable oils, and why we are in a crisis, because we had to produce import cod palm oil from Indonesia and Malaysia. Yet, by the way, we actually have a very big farm in Kalangala, which is not necessarily producing yet, but also in Congo. When we went to Congo, we discovered they have a lot of cod palm oil, which we could have been getting next door, but we had preferred ignorantly to go and get it from Indonesia and Malaysia. So there's something good that comes out of every crisis. Then we also have textiles, sugar, salt, fertilizers, and for the services, we do a lot of transport, importation, construction, medical, and all these things, and you can see all the labor flight that is leaving the country. So for me, we have a lot of opportunity, but we need you as the financial services sector to zero in into a mechanism and a framework that is going to really work very closely and with the private sector so that it just fits very perfect onto the deliverable platforms. And as other government departments, we are more than happy to partner with you in delivering some of these things. So the first thing which I talked about where the actual financing gaps are, and I am asking also that we have another forum where we can give you the actual statistics on exactly those funding gaps line by line, so that people, you don't, reinvent the wheel. The information already exists within the country. You don't have to sit down and start cracking your heads and start researching afresh. So these financing gaps can be fulfilled by you people sitting down and designing your, by the way, even the bonuses. Mr. Chiemba talked about your bonuses being tied to some of these deliverables, how each bank is doing on helping private sector industrialization, as well as import substitution, as well as export promotion. So maybe if that's a good idea, people might actually deliver on what is being measured. If you're not measuring it, it will not be managed. There will not be progress. So maybe it's food for thought for the banking industry as well. So there's a lot of little technologies, but also the investment on technology and delivery. So digital financial services report from the World Bank. And I'm glad there's someone here from the World Bank. Mr. Cassidy, thank you so much for coming. It alludes to the potential of digitalization of services powered by fintechs to lower the costs of economies and increase scale, because scale is also a very big problem. 2 months ago, someone placed an order from Uganda to just send beans for 6 months. There were people so excited, I put them in touch with the markets in Dubai, and they only supplied beans for 3 months. The rest of the 3 months, they could not supply. Why? We are not organized in a way that we can supply. I'm glad that you're also talking about the export fund. And also, if the fund is very expensive, people will not access it. The bureaucracies on the applications for funding is also a problem. Please, the paperwork that needs to be done for these small people, it's already intimidating for them to walk into a bank branch. And by the time they put themselves together to start producing for you, it is already very difficult for them. So the paperwork, please, just compress everything and maybe give them the services on their phones, give them the services in one stroke of an application so that they can access these services to buy inputs, to facilitate the value chain in a meaningful way so that they are not bogged down in paperwork. So that transparency, the speed and ease of transaction security and transparency was very poor, according to that report. And they urged the adoption of initiatives that could amplify post-COVID-19 transaction out of our financial services. There was also something which I want to bring to your attention, really, which is the Universal Financial Access, UFA 2020 goal. This was produced and it was aimed at ensuring that adults globally have access to a transaction account or electronic instrument to store money, send and receive payments as a step forward towards broader financial inclusion. But Uganda banks therefore must also acquire the same goal so that they are in tandem with this universal financial access. So that people can find it easy to access your financial services to facilitate trade and production and industrialization. So we need to promote trade, improve productivity and quality of life. So there is need for banks to undertake comprehensive research, diagnostics, credit risk review with the aim of having a wide presence in the MSMEs, because you are the people who are going to graduate these MSMEs from where they are into middle, into the bigger people that you see. And I'm glad that Mr. Chiemba also talked about it. So climate smart projects, because we are talking renewable energy and sustainable manufacturing. It's very important. Everybody who's going on the agro-industry and all value chains. They must actually do responsible lending, sustainable manufacturing development and support. So I would like to inform you that the government through our ministry is currently doing a study to establish a cooperative bank. Why we wanted to do the cooperative bank is because we realized that the product range on the market is insufficient to service the very last person who would like to join cooperatives and produce collectively in scale. So please do not hit us or compete with us or chase us. We need your support. But as we said, we are going to be partnering with private sector to deliver some of these things. So everybody has a niche in the market, and the market is just beginning to grow because there are more and more members joining the East African community. We have COMESA, we have the African Free Continental Trade Area. So, and sometimes, I mean, people call from Egypt, they want milk. And there's no trade facility to even help them on milk. So we just need to come together and use this information on trade, industry, and cooperatives in a way that everybody benefits. So there will be no fights, but we just need support to do that for the last guy. So ladies and gentlemen, I'm not going to go into the details of the East African exports because we know, as you talked about DRC, just know that we are launching the Mpondo Border Export Zone, OSBP, the one-stop border post. And by the way, we need some banks in there because there's a lot of foreign exchange needed and financial services needed on some of these border posts. There's the only border post actually in Mpondo is the one with a cold room. So you can even export all your fresh dairy and fruits and vegetables. 2 very big rooms and they're all free. And people who are on the value chain of production don't know about this, but I'm sure we're going to do some publicity for them to know. So even Goma and Goli, they're all upcoming. The growing market and opportunities we shall also be putting on our websites, but as well as continuing to share the information where banks would like to position themselves and gain out of all this trade. So the choice is going to be yours to embrace and take on these opportunities. So I call upon all these bankers today, stakeholders, and all the people producing and all our development partners, government including all the strategically included stakeholders together to help transform our country into proper middle income status. So I sincerely hope that this conference and discussions will yield the results that we need. I look forward to hearing from you, this fraternity, the feedback. We see the reports and we see how we can actually partner together. And many of you have been contacting me to get the parish development model circles because you want the circle money, you want cheap deposits. You're welcome. And there's a lot. I mean, it's 11,594 parishes. Everybody wants a piece of that, but I think we can do more than just waiting for these circles to register. And I mean, bankers, you're bigger than that. You're deeper than that, registrations and getting deposits. So please demonstrate to us that you can actually go deeper into our value chains of production and manufacturing. So we shall take away these resolutions, we shall wait for them, and then we'll see what happens next year and how far we have gone. With all this, I do not want to bog you down any further, and I wish you very good deliberations. If anybody has any questions, I operate open door policy, and I wish to stop here and wish you all the best in the next 2 days for God and my country.
Wonderful. Thank you so much. Permanent Secretary in the Ministry of Trade, Industry and Cooperatives. I try to repeat that. Thank you so much, Geraldine Sally. Never one to mince her words. And I've seen a lot of pen to paper as she spoke, which is a good thing. So here goes. We'll have discussions, which means there'll be, as you've seen the setup, there'll be panels. There'll also be a keynote address. So if there's any question or a comment, it might not be easy for you to remember it as the conversations go on. Note it down. We've put, I think, specific books and pens wherever you are. That way we'll be having a Q&A session that is broken down into 2 sessions. So keep the thought. If you think it might go away, write it down. Please, by the way, just to recognize, because part of our theme is including agribusiness sectors, and our powerful sponsor is ABI, or the Agribusiness Initiative. ABI, are you here? Where's the team? Oh, there you are. Thank you so much. And I was actually told that at the start of the Bankers Conference, there's a specific sponsor that has stayed from the beginning till today. Does anybody know that sponsor? Who's that? Ah, I hear the whispers. MasterCard, right? A round of applause, because 2017 till today, they've been title sponsors. So please welcome the country manager for East Africa, Mr. Sharia Ali, to give us a few remarks. Please welcome. This deserves a round of applause. Thank you.
Good morning, everyone. My name is Sharia Ali. I'm the country manager or area country manager for MasterCard covering East Africa. So that's 15 countries from Sudan all the way down to the Eastern Seaboard and the Indian Ocean Islands. I'd like to start by thanking the Uganda Bankers Association for the warm reception and your support and partnership. I'd like to specially acknowledge Honorable Dr. Wilbur DeWar, Chairperson UBA, Ms. Sarah Rapta, Permanent Secretary, Ministry of Trade, Industry and Cooperatives, Ms. Geraldine Sali. We just heard from a very impassionate plea and address from her, and I really felt it. I'd like to also thank Uganda Manufacturing Association Chairman, Mr. Tio Kayamba, and Bank of Uganda Deputy Governor, Mr. Michael Atingi Ego, and the esteemed guests and leadership present in this hall today. Before we dive into the agenda for today, I'd like to share a misconception around MasterCard. So our name kind of creates this illusion, or maybe a rightful one, that we're a cards company. Well, just like Apple is not selling fruits and Amazon is not a shop on the river in South America, MasterCard is much more than just cards. We started out as a cards company for sure, back in the day, but the world has changed so fast that we had to pivot and we had to change our direction. So we are now a technology company. We operate on multiple rails, which are inclusive of accounts, cards, remittances, e-commerce, blockchain, and the list goes on. Our solutions are accepted at millions of MasterCard branded merchants and ATMs across 210 countries. And I'll share a little bit about what MasterCard intends on doing and how we're collaborating in the region. But let's first understand the problem. If you think about it, and when you say we, and at the topic of this conference where we're looking at manufacturing, agri-sector, and tourism, these are sectors that have been most hit by the VUCA world that we are living in. And volatility, uncertainty, ambiguity, and complexity is resulting in accelerated evolution. The question is, why are we accelerating and why are we evolving? And the answer lies in the fast-changing needs, priorities, and evolving consumer behaviors. So if you look at ourselves, let's say we're awake about 16, 17 hours in a day. Out of that time period, 4.5 hours, we are sitting in front of screens. Some of you are sitting in front of screens right now. Now, if you come out with a solution which does not cater to that form factor, chances are there's a high probability that your loss of relevance is guaranteed. And let me give you another example. How many people in the hall remember that beautiful relationship between a pencil and a cassette tape? I'm dating myself here. There you go. What a pleasure it was, yeah, when you had to like fix the all jingled, tape. Or, the amazing CD player or the Walkman. When I talk to my kids about it, there is no connection whatsoever. It just doesn't exist. You know, they look at me, I'm like I'm a dinosaur. But you know, now we have these, you know, online streaming platforms like Spotify, millions of songs available for, you know, at your fingertips. No need to go anywhere, no need to bargain, nothing. Let's look at the textile and the health sector. So what did COVID do? As soon as COVID came into play, what did the textiles and the health sector and many other manufacturing industries, they had to pivot. It wasn't a pivot of their choice, it was something that came out of necessity. Because we needed PPEs, we needed the personal protection equipment, right? We needed the vaccines, we needed the infrastructure for the distribution of those vaccines. So that tells you suddenly we showed our resilience as the human race and we addressed the need that was there. If we bring our focus now to the Pearl of Africa, our fast-growing Ugandan economy at pre-COVID levels of 6% plus. I mean, I think right now we're run rating at about 3.5, 3.6. What challenges did we face? It is COVID, yes. It is the Ukraine-Russia war yielding inflationary pressures. Inadequate rainfall hurting the farmers big time in our part of the world. And of course the slow rebound of tourists coming back into our region. If this is not VUCA, I'm not sure what is. So our previous CEO, Mr. Ajay Banga, shared with us a nice geometric figure of a triangle and kind of explained it in a very simple way. And he said that, look, if you look at a triangle, on one side you have the challenge of the one versus the many. And by this he was referring to financial exclusion, where those who lack access to financial services due to their gender or socioeconomic background suffer the most or are left at the periphery of the society. On the other side, he showed us man versus nature. Guess what? The inadequate rainfalls, the rising temperatures in Europe, record temperatures that we are seeing these days, global warming as a whole. These are all factors that the environment is pointing towards us that we better think about our working environment and our businesses in a sustainable manner and hold ourselves accountable. At the base of all of this was a choice that all of us make day in, day out, or maybe around the planning season. So this is perfectly ripe because I think a lot of us will be going into our budgetary sessions, or maybe we're already in it. But the choice between deciding for the short term, where we have a value to deliver to our shareholders, versus long-termism, thinking about sustainability, thinking about what's the right thing to do today. How do we, for example, I mean, if you look at the MSMEs, how much pain have the MSMEs gone through during COVID? A lot of them have just been wiped out. And guess what? They were looking towards us and were looking for us to help them and partner with them and be flexible with them. And I think that choice, it's becoming evidently clear. Short-termism just won't work. We need to have a balanced approach and ensure that in the long term, what we are doing will deliver value to not just us, our future generations, and our countries. So if we were to walk away with three principles that we could develop on during these 2 days, I would say partnerships are key, as we are much stronger together than individually. Public-private sector partnerships to shore up and strengthen manufacturing, agri-sector, and tourism is critical. Access to finance is vital, empowering the economies and business sectors. FIs, generally, or any underwriting organization can only do so if there's a digital footprint. Unfortunately, cash doesn't provide us that, and so we need to be enablers of digitalization in our ecosystems so that all that transactions and commerce is recorded and it'll make your decision making easier. And that's where MasterCard plays a pivotal role. Lastly, we must continue to invest in the tech infrastructure and the networking infrastructure in our part of the world to ensure financial inclusion in its spirit. So what is MasterCard up to? I'd like to just showcase a couple of examples amongst the many. The first one is the MasterCard Farm Pass, which we are proud to have launched in Uganda, working closely with Yo Uganda and Equity Bank, and I am certain that we'll be rolling out with many of our other partners in the market. What does this program do? So it's basically a digital platform that connects smallholder farmers to credit, high-quality inputs, and market access. It gives them an improved access to buyers and increased price transparency, enabling many farmers to command fair prices. FarmPass now consists of 900,000 farmers already enrolled, and we do believe that at the current rate of about 40% growth year on year, the numbers are only bound for the north. In the tourism sector, we have recently gotten into a partnership with the Kenya Tourism Board, and we're already in talks in Uganda and Tanzania and a number of other countries, where we're entering into a 3-year collaboration comprehensive MOU and agreement. The goal of this MOU is to drive tourism numbers by leveraging MasterCard's various assets. One of them is the Priceless.com platform. You can visit it and see what it has to offer in terms of attracting global attention. We've got the Data Insights platform. We have the terminalizing of not just the national parks, but all tourist sites across the various countries so that foreign tourists can come in and not have to localize their payment form factor, but rather use the ones that they already have. We are further going to curate loyalty and rewards programs to boost tourism through partnerships with all of you, and of course, roll out campaigns. This will be replicated in Uganda in the short term, and we're looking forward to that. I also want to thank you for your time invested over these 2 days, and I reiterate MasterCard's commitment to Uganda, which will yield in increasing MasterCard's presence locally, including a locally registered entity, which gives me great pleasure and pride, and representation on the ground as well. Please enjoy, co-ideate, collaborate, and let's partner together to make an impact for our future generations and ourselves. Thank you very much.
Thank you so much, Mr. Sheria Ali, who is Country Director for MasterCard. And speaking of sponsors, we do have our partners who have some products and information for you. Once you walk outside, there is a big tent, which is our exhibition booth tent. The exhibition is going on throughout the day, today and tomorrow. So if you catch a breath, you might want to go there and see. Not break yet, though. Allow me to welcome back Ms. Sarah Rapta, who's our chairperson, to invite who should be our guest of honor today to give us a few words from our co-host and really a guest, but also co-host, really, Bank of Uganda. Please, Sarah.
Thank you, Flavia. It's my distinct honor and pleasure to invite our Deputy Governor, Dr. Michael Ego Atingi.
Thank you, Sarah. All protocol, as earlier mentioned, is observed. A very good morning to you, ladies and gentlemen. Before I delve into my remarks, I want to beg your indulgence to take a moment to remember our departed gallant governor, the late Professor Emmanuel Tumusiime Mutebile, who died in January 2022, and for whom I'm humbled to speak to you today in a place where he previously spoke. and also to spare a thought for the lives lost during the catastrophic COVID-19 pandemic that struck the world in a crisis like none other. Just a moment, please. Thank you. Ladies and gentlemen, it's an immense privilege to address the 5th Annual Bankers Conference, and I'm most pleased that Professor Benedict Oramah, President of the Afrexim Bank, will address us through his trusted delegate, Dr. Fofak, who's going to be our keynote speaker. The theme, Bridging Financing Gaps in the Manufacturing, Tourism, and Agribusiness Sector for Economic Recovery and Growth post-2021, is an aptly chosen theme for this year's conference. Allow me to quote from the book of Ezekiel, chapter 22, verse 30, where it says, the prophet said on behalf of God, quote, I searched for a man among them who would build up the wall and stand in the gap before me for the land, that I would not destroy it, but found no one. For emphasis, not even one. We'll get back to that later. The COVID-19 pandemic, the geopolitical conflict, climate change, have breached the safeguards for lives and livelihoods with unfamiliar havoc. The Russia-Ukraine war sucked the momentum out of economic recovery following the ending of the lockdowns and social distancing measures to contain the spread of the pandemic. Shortages of essential commodities have spiked inflation, resulting in tighter monetary conditions worldwide. In addition, and in the case of Uganda, drought has added pressures to the strained supplies of agricultural produce, thereby hiking the risk of hunger and stoking inflation further. Moreover, protectionism abroad has forced prioritization of domestic industrial capacity. But uncertainty about economic growth expectations due to several shocks hitting the economy has made banks shy in advancing credit to the private sector for fear of potential defaults due to poor business prospects. The financing gaps will constrain the rejuvenation and enhancement of local industrial capacity to cover the supply shortages bedeviling the economy. It is a testament to an active social consciousness that the banking fraternity is examining its duty and capacity to seize the moment and step into the breach caused by the crisis ravaging the lives and the livelihoods today. In examining whether financial institutions are up to the task and responsibility of supporting industrial recovery for high economic growth, this conference demonstrates that the banking sector seeks ways of stepping into the breach. We are pleased to see that the banking sector is responding to the call by His Excellency the President, Yoweri Kaguta Museveni, for the financial industry to actively support the community in which they operate on top of making profits for their shareholders. Recall His Excellency the President recently asserted that, quote, the financial sector is key to sustainable economic development through mobilization and use of domestic savings and investments. But, unfortunately, the sector is not reaching its full impact and is far away from playing its due role in bringing prosperity to all Ugandans. This conference shows that the banking sector is ready to meet the challenge posed by the President by exploring their role in propping up and powering Uganda forward, particularly the industrial capacity, especially in manufacturing, tourism, hospitality, and agri-business. Ladies and gentlemen, please read the conference magazine that has been distributed to you, paying particular attention to the foreword of the chairperson, Uganda Bankers Association, the permanent secretary, Minister of Trade, Industry and Cooperatives, and that of Ministry of Tourism, Wildlife and Antiquities. Their statements indicate the potential impact of manufacturing and tourism on economic recovery and the specific approaches the banking sector can undertake to unleash the sectors. So please take a moment to read it later on. We expect that by the end of this conference, it will be clear how the banking sector can play its role in unlocking the full potential of finance in catalyzing economic growth and prosperity for all Ugandans. The banking sector can play its envisaged role of spurring the economic recovery because it remains solid and resilient, having entered the pandemic with sufficient capital and liquidity buffers. The Bank of Uganda regulatory and supervisory framework, supplemented with interventions such as credit relief measures, restrictions of dividends and discretionary payments, and liquidity assistance, stilled the banking sector from the worst effects of the prevailing shocks. Consequently, banks hold strong liquidity buffers underpinned by growth in liquid assets, mainly government securities, of course, and deposits. The aggregate liquidity coverage ratio was about 185% in June 2022, above the minimum prudential requirement of 100%. So to date, banks hold sufficient capital. They meet all the capital adequacy requirements, capital conservation buffers, and the respective systemic risks, capital buffers requirements where required. Solvency stress tests showed that banks were resilient to potential shocks, including credit risk, at least in March 2022. In addition, increased profits boosted the capital and liquidity of banks. So, as banks take on the mantle of stepping into bridge the restoration of credit growth to pre-pandemic levels and above, they must maintain fidelity to prudential standards, primarily because non-performing assets ratio has increased to 5.8% at least in March 2022, and the operating environment has remained challenging. The recent shilling exchange rate depreciation and inflation surge complicate the operating environment further. Therefore, we hope today and tomorrow's conference sessions will consider how bank financing can stimulate productivity growth and high-value exports to boost overall growth and forex inflows. We also urge the banking sector to finance enterprises and activities that preserve and protect the environment so as to manage the associated climate risks. Slanting financing towards industries without smokestacks, such as tourism, agribusiness, thus promote the environmental, social, and governance principles consistent with a sustainable financial sector. It is therefore my hope that this conference will also address itself to the very topical matters that are related to environmental, social, and governance sustainability, and how these pillars can best be incorporated in financing investment decisions, more so in the manufacturing and hospitality sectors, which have been singled out for this conference. In hospitality sector, Uganda is referred to as the Pearl of Africa because of its beautiful sceneries, a diversity of wildlife, hospitable and friendly people with different cultures, and amazing climate all year round, notwithstanding this year, of course. This offers great opportunities for banks' involvement in a number of sustainable ventures that involve funding in the reduction of greenhouse emissions and improving resource efficiency in key tourism value chains such as foods and beverages, accommodation and meetings, conferences and events. For instance, banks could develop funding opportunities for ecotourism ventures. Similarly, there are several opportunities in the manufacturing where banks can play an immense role in promoting sustainable buildings and construction and circular value chains, for example, in the textiles and the plastic value chains to increase reuse and recycling rates. However, all this requires deliberate efforts to craft financing instruments that are specifically aimed at promoting ESG to affect the long-term sustainability in these and other value chains of institutions, and that also support the socio-economic transformation of the communities in which the projects operate. Ultimately, it's going to take a multi-pronged and a multi-sectoral approach to sustain the recovery and achieve high economic growth at the transformative levels of 7% per annum and above the post-pandemic levels. The Bank of Uganda's most significant contributions to sustained economic recovery is fostering price stability and a sound financial sector. Therefore, within our mandate, the Bank of Uganda is prepared to do whatever it takes to restore inflation to low and stable levels in line with maintaining macroeconomic stability. In conducting monetary policy, we are guided by our judgment that the average core inflation should be 5% 2 to 3 years ahead. Inflation above 5% target retards economic growth by compromising long-term planning and hurting savings and investments. When inflation surged recently, driven by external factors and drought, the Bank of Uganda increased the central bank rate and augmented the monetary tightening by raising the cash reserve requirement for banks to 10%. The tight monetary stance will be maintained and enhanced to prevent price increases, which are now generalized across consumer goods and services, from becoming persistent and spiraling out of control. As I come to the end of my remarks, I want to thank the members of the Uganda Bankers Association for leveraging technology to maintain the delivery of financial services throughout the pandemic. Thanks also for delivering and matching the government Small Business Recovery Fund, SBRF, to support small businesses hit by the pandemic. Amidst the ongoing challenges and uncertainty, the Bank of Uganda and government do appreciate the vital role played by the financial sector in maintaining stability, service delivery, and reassurance. We look forward to the amping up of the banking sector's role in supporting our recovery with new investments, lending, and innovations to keep the economy advancing. I'm optimistic that this conference will craft a fruitful way forward by answering the question, are financial institutions up to the task and responsibility of filling the financing gap in manufacturing, tourism, and agri-business? And of course, by heeding to the call of the PES, Permanent Secretary Trade, Industry and Cooperatives, and the candid point raised by the ED, Uganda Manufacturers Association, and also the thoughts of the country director, MasterCard, we are going to find a man who is going to build the wall, stand in the gap for the Lord, and we will do what is necessary to ensure that socio-economic transformation is undertaken in this format. So let me end my remarks by thanking the Uganda Bankers Association for convening this conference on the vital theme, and the President of Afrexim Bank for delegating Dr. Fofak to deliver the key address. And I thank you all for listening to me, and God bless you.
The Deputy Governor, Dr. Michael Atingi Ego. Thank you so much. Ladies and gentlemen, it's time for us to have that conversation. Just to remind you that as the keynote address is being presented, for all your questions, concerns, comments, please jot them down. We'll be having a Q&A session right after. But allow me to now welcome Mr. Hippolyte Fofak, who's the Chief Economist and Director for Research and International Cooperation at Afrexim Bank, to deliver the keynote address with our theme in mind as a topic.
morning, everyone. I can barely hear you, actually. Good morning, everyone. And I would like to join the Deputy Governor in stressing how the protocol has been observed, and really thanks the Deputy Governor for really welcoming us to Uganda this time, and thank the Ugandan Banking Associations for associating us to this important event, and quite frankly for welcoming us, Afreximbank, within the Uganda Banking Associations earlier this year. And my president, Professor Benedict Orama, the chairman of the bank, could not come. I think he was really looking forward to this event. Unfortunately, had to really stick to prior commitments, but he made sure that the bank is well represented in this event. So I am here with my colleague on the left table. I think we have at least 3 or 4 of us. Really show that the bank, Afreximbank, is fully part of this important initiative. I think the theme of this year is actually quite an important and timely one, as the governor said so well in his opening remark, and we fully concur. And I just wanted to start by, how does this work? Very good. I wanted to start this presentation by taking us through a quote by no other than John Maynard Keynes. The difficulty lies not so much in developing new ideas as in escaping from the old ones. And as the governor said, the old ones have been the colonial development model of resource extractions, which has not really helped in terms of volatility, but also, as said earlier by the chair of manufacturing associations, the idea that there is a higher risk, that manufacturing is too risky. So you combine those two, those are the old ideas that we now have to overcome to create the conditions for sustainable growth and to set African country, Uganda in particular, on the path of fiscal ended sustainability. I thought we should open by this important statement by John Maynard Keynes. And we will actually take you through, we have a comprehensive presentation, but I think we are going to emphasize the financing part of it, and which essentially it's important to stress that despite the tremendous potential for economic transformations, the contributions of manufacture and tourism to growth remain marginal within the African continent, and despite the fact that we have a very beautiful landscape, and we are the only part of the world where safari remains a possibility, I think it's something that we're not really fully exploited. And according to most recent estimates, I think manufacturing outputs account for just about 12% of GDP in Africa, against more than 20% in Asia, which, as you know, has become the world hub in terms of industry. Of course, there are significant differences across countries. I think if you look at Swaziland, for instance, it's almost at 27% of GDP against Uganda, which is essentially around 16%, not very bad, essentially above the continental average for that matter. And the story is somehow similar in the manufacturing sector, in the tourism industry, which has been one of the major sources of foreign exchange earning, especially in the least natural resource dependent economies. But despite its natural beauty, as I said, and the impact of hospitality industry within the continent remain quite marginal. I think if you look at the global figure, more than 1.7 trillion, I think Africa capture just about 2%, which is really not enough for such a large continent, which has a comparative advantage in natural scenery, as well as the fauna and so forth. But the Lilliputian nature scale of African manufacturing and hospitality industry has tremendous cost beside the fact that integrating the global economy, which is largely driven manufacturing, it's an issue. There are costs way beyond that aspect. And this is, if you just look at the global value chains alone, which before the pandemic were already at more than 50% of global trade. And if you add the non-global value chains, you can see that essentially you perform in the global environment only if you are in the manufacturing space. And going the commodity route will not take you very far. The global contribution of commodity is less than 15% of global trade. I think that's the way forward, essentially. But over the years, I think manufacturing has been a reliable vector of welfare improvement. Essentially, the path out of poverty has been through manufacturing. It's not just an issue of foreign exchange reserve, it also has implications for welfare, in fact, significant implications for welfare. And within the African continent, where unemployment rate have been at Great Depression level, over 30%, if you look at South African numbers, it tells us that this may well be the reason, the rationale for us to really invest in this sector beside the foreign exchange earnings. And I think the choice, as the governor said earlier, of the riding team is actually very timely, but also extremely relevant from the standpoint of development impact. Africa, which depends heavily on manufacturing import, was particularly vulnerable, found itself in a very vulnerable spot after the COVID-19 outbreak. We could not import, even those who could afford, could not import COVID-19 equipment, ventilators, vaccine nationalism. I think we found ourselves very vulnerable, calling for us to really boost our manufacturing capability, to reduce our vulnerability to global volatility, also vaccine nationalism, also nationalism in general, what the governor called protectionism in his opening remark. Over the years, I think against this background, I think it is important to building back better. And building back better for the African continent may simply mean winning itself of that excessive dependency on import of manufactured goods and taking advantage of the AFCFTA, which entered into force last year, will be essentially an industrialization accelerator, especially as we fully implement the rules of origins, which is essentially a passport for industrializations. But financing is one of the key constraints on the path of that sustainable growth in manufacturing and hospitality sector, as said earlier by the previous speaker. And the key questions which is posed by the Uganda Bankers Association this year is, are African financial institutions doing enough to support these two strategic sectors? And what should be done to bridge the financing gap in this sector and set the conditions for structural transformations that we so much need? And then this takes us to really providing an overview of the state of manufacturing and hospitality within the continent. I'll be quite brief in this section. I'll essentially zoom through it. I think the right answer to the question, can manufacturing and hospitality catalyze growth post-COVID-19? The answer, quite frankly, is yes. And for several reasons. I think these are tremendous growth industries, and Africa has tremendous potential, which are still very much unexploited, whether it is in the tourism sector or in the manufacturing. And then we have another important aspect, not so much talked about, the favorable demographic trend within the continent. I think for all these reasons, it's very important to stress that, yes, it is the right thing to do, and they have tremendous potential to help achieve that goal. And for instance, if we take the tourism industries, in a sign of post-crisis normalizations, tourism-dependent economies are set in the current projections to achieve tremendous growth in 2022. And one example is Mauritius, which essentially went from 14% contractions in 2020 to about 6-7% growth rate forecast for 2022, pointing to a resumptions in the tourism sector. As for the manufacturing sector, which has sustained country on a robust long-run growth trajectory, the East Asian miracle, which reshaped the contour of the global economy, was essentially a manufacturing miracle, an export-led growth model. And that manufacturing revolutions, which positioned Asia, as I said earlier, as a manufacturing hub, the factory of the world, has actually also prepared the continent, the Asian continent, to capitalize on global value chains, export-led growth model, to become a powerful force. And the contrast between South Korea, for instance, and Uganda is illustrative. But we can also look at the contrast between, let's say, Vietnam and Mozambique, as we will see earlier and later in the presentations. But manufacturing is also the dividing line between developed and developing countries, between rich and poor nations. And across advanced economies, output manufacturing as a share of GDP is actually very high in the 20-25%, whether China, Korea, but also Germany, the leading country in that regard. Besides providing the path to an effective integration into global economies, manufacturing which accelerate the process of structural transformations and foster inclusive growth has been the most efficient vector of poverty reductions, as the contrast between Vietnam and Mozambique actually shows. Even though the two countries achieve robust growth rates above 5% for a long period of time, reductions in poverty was actually more significant in Vietnam's, in part because Vietnam has been more labor-intensive, export-led growth model than Mozambique, which rely heavily on commodities, essentially on capital-intensive, essentially export. The shared population classified as poor in Vietnam, for instance, fell to 13%, while in Mozambique, over the same period, approximately, was around 55%. Essentially, most empirical studies actually support the positive correlation between manufacturing output growth and economic growth. But not only is the share of manufacturing in GDP positively correlated to economic growth, but the negative related to poverty also suggests that the impact of manufacturing for low-income countries on poverty score is actually more pronounced and significant than what one would think. Now, to close on this section, I think it's important to also look at the theoretical foundations. I think in addition to supportive empirical evidence on the importance of manufacturing for development, I think the theoretical foundation is also very strong. And for instance, manufacturing offers special opportunity for capital accumulations. And we look at the US case where we have most recent data, which estimate that manufacturing drive almost 20% of capital investment in the USA. In other words, through manufacturing, we can actually change the landscape of investment across the country, moving away from essentially the vulture economy where they come and get the resources to inject the patient capital that's more sustained over time. The manufacturing sector also offers special opportunity for economies of scale and productivity growth. The US example, again, shows that it accounts for almost 35% of productivity growth. In other words, exactly what we need to become globally competitive. And finally, I think manufacturing sector offers special opportunity for technology transfer, which is what Africa needs most. The governor talked about climate change, but the success on climate change is on the technology, the right technology. Otherwise, we are going to be the lagging vector again in the global context. The manufacturing sector enhances the linkage and spillover effect, and to create the positive externality to investment in any given sector or subsector. So I think it's quite clear to us that this is really the directions to go. And banks and financial institutions, you'll be surprised, bankers, which invested heavily in the manufacturing sector in Asia, have actually been surfing on a robust long-run growth trajectory over the past decade, which has seen the balance sheet exploding. Suppose you were a banker, wouldn't you be investing in Sony or Mitsubishi? Wouldn't you? Say that I'm the one who financed research and development in Mitsubishi for this sea-moving boat and so forth. I think to be part of those actually create the conditions for joint growth, both at the corporate but also at the banking and financial institution level. But the benefit of manufacturing extends beyond commercial banks and corporate in an economic setting. I think manufacturing is macroeconomic stabilizing, Mr. Governor. And by sustainably growing foreign exchange reserve earnings and mitigating the exposure to recurrent adverse commodity price cycle, they provide the financial wherewithal, the chessboard that central bankers need to effectively manage their economies. So it's actually a win-win for everybody, the corporate, the bankers, but also the central bankers. Now, bridging financing gap manufacturing and hospitality sector, are we doing the right thing or are we doing enough? And quite frankly, and as said earlier by manufacturer associations, they are at the heart of the process of structural transformations. And the current deficit of the continent in the global manufacturing space arena is a clear indication that perhaps we are not doing nearly enough to address their concern and to grow that sector. And none of these constraints perhaps is as important as financing. There are several other constraints, infrastructure and so forth, but infrastructure somehow also relate to financing. As we know, infrastructure financing gap across the continent largely exceed $200 billion per annum. So financing is somehow at the heart of some of these constraints. If you look at just the SME space, the SDG space, I think the financing gap across the continent are huge, and $420 billion per annum just in the SME space. And if you zoom into Uganda, we are talking about almost $9 billion annually, just for, the financing gap for SMEs. This is significant. It's a major constraint. So even before the outbreak of COVID-19 crisis, which like other economic crises, amplify the risk of pro-cyclicality of bank lending, I think they are refractory to risk. But even before that, financing was already a major challenge in the sector if you go by the size of the financing gap. Across the regions, these growth industries, which are key to reducing the credit rating negative correlations, rating agencies, between growth and commodity price cycle, have been considered too risky, as mentioned earlier. But data from the Central Bank of Uganda show that lending to manufacturing industries has remained very low. If you just look at 1 month in particular, I think was about 1-2% of total lending in the lead up to the crisis. I think this compares unfavorably to countries such as Egypt, which have invested heavily in manufacturing, where the lending toward that sector is around 30%. But the ratios are even higher. In Asia, manufacturing has been the major drivers of growth. If you look at I mentioned Asia, but I can also mention Germany. If you look at the portfolio of German banks, invest heavily in manufacturing. But most recent for the Central Bank of Uganda do not point to a drastic shift toward a significant increase in lending toward this strategic sector post-COVID-19. But the challenge of bridging financing gap in this key sector, quite frankly, is not specific to Uganda. It's a continental problem. In Nigeria, for instance, it is very important, the largest economy on the continent, the Central Bank of Nigeria, CBN, had to adopt a policy setting a loan-to-deposit ratio minimum threshold at 65% to boost lending to the private sector in December 2019. And with view to actually addressing and curbing the rather unfettered appetite toward government securities, which are essentially, as mentioned earlier, risk-free propositions. Before the CBN policy, and loan deposit ratio in Nigeria was about 57%, and compare that to 91% in South Africa, or 76% in Kenya next door. And I look at the data from the Central Bank of Uganda, they were around 50%, 51% for commercial banks in Uganda. I think a review of CBN last year showed that the impact of the loan deposit ratio policy was both significant and, quite frankly and remarkably, almost immediate. I think at the height of the COVID-19, between January 2020 and January 2022, I think lending in Nigeria to private sector increased dramatically by almost 40%. It's quite remarkable. But what is also remarkable is that that dramatic growth during crisis, when pro-cyclicality should be advising otherwise, did not lead an increase in NPL ratios. In fact, first lending was more directed toward, if you look at this graph, the next graph, toward manufacturing, which beside oil and gas, which have dominated lending, the financial sector, Nigeria may be engineering its way out of the long, dreadful. In other words, more than fostering counter-cyclical financing by banks, the loan deposit ratio policy is creating the conditions to build back better post-COVID, expanding manufacturing. At the same time, I should say, the sharp increase in bank lending, private sector, did not lead to a deterioration of the balance sheet, as the review of CBN shows. Across the Nigerian banking sector, average NPL ratio declined to 4%, the lowest in years. In other words, the growth of this critical sector is perhaps wrongly affected by the excessive risk premium, which is reflected in the prohibitively high interest rate, including in Nigeria as we speak. I think across Nigeria, the average interest rate on loan to manufacturing sector was actually, in SMEs, actually very high, around 15.5%. So they still have a long way to go. Of course, it has to be related to inflation for that matter. And across Uganda, the lending is also just as high if you look at the latest figure we receive. I think this prohibitively high interest rate have set unrealistically high expected return on investment, and in the process, in our view, undermine growth and economic transformation to strengthen the foundations of the highly extroverted colonial model of resource extractions, which we said has a lot of risk in terms of setting country on the path of fiscal and debt sustainability. In Nigeria, the CBN is aggressively pursuing the dual mandate of price stability, but also achieving long-run growth through structural transformations. I think they're leading the charge of actually exiting those risks. In this context, they've actually entrenched financial operations, interest rates, but also the perceptions. They are partnering with the Exim Bank, development banking, to actually provide direct financing to the manufacturing sector, but also diversify the source of growth. We can mention what the trillion naira is actually providing support to that sector. While the activist stance of Central Bank of Nigeria is yielding results, in our view, Mr. Governor, changing the institutional culture of financing and deployment of resources which prioritize risk-free government security and large multinational company is perhaps key to growth, to engineer sustainable growth in the manufacturing and hospitality sector. And available empirical evidence shows that unlike OECD countries, banks in developing countries primarily target large enterprise representing just about 1% of total firm. I think that's the data, that triangle that we mentioned earlier. You can see that large concentrations bottom where most SMEs in manufacturing had to rely essentially on microcredits as a result of the reluctance of banks. This is a global picture, the state of the art in the developing world, non-OECD countries. By contrast, I think micro firms, which 70% of total firms get meal credit and set on microfinance institutions. However, I think the growth of manufacturing industry and SMEs, which are critical for healthy recovery, considering the potential of this sector for employment and integration into global economies, require both large and patient capital, both of which cannot readily be made available by microfinance institutions. And I think the development banks and finance institutions have played a major role in the rise of manufacturing. I think if you look at Germany, their development banks have been the major drivers of growth in Germany after, in the turn of the century, in 2010, and they've seen that as a result of those banks disappearing, there's been a major drop in actually industrialization in India. Now there's a call for the current government. Now, I just want to take you through quickly to what Afrexim Bank is doing on its part to support this mandate, and then we close. I think, as I said, even before the outbreak of COVID-19, the bank had actually prioritized manufacturing, hospitality, which are, in our view, key to diversifying African export, but also the source of growth. I think these strategic sectors have been reflected in the bank's successive plan, Plan 5 and Plan 6 currently, and they emphasize essentially intra-African trade and AFCFTA implementation, the current plan, but also industrialization and export development. And so even before the pandemic, the bank has taken that stance. And interestingly, the two pillars, the first intra-African trade and industry, dominate intra-African trade. So as you grow intra-African trade, you will actually carry along industrialization and manufacturing. It's a wonderful opportunity, the AFCFTA, for the rise of manufacturing industry across the continent. So to bridge financing gap under its successive plan, the bank has really supported the growth of this strategic sector through direct financing, but also through innovative financing mechanisms. For instance, the bank disbursed over 1.4 billion over the last 5 years toward manufacturing projects, which includes refinery, fertilizer, but also light manufacturing, agro-processing project, and manufacturing plant for beverages, but also tea. And we are set to essentially double that amount in the coming years. And already we have in the pipeline almost $3 billion project that we are under considerations. The bank direct support toward hospitality has been through its Contour program, which aimed to lay off construction risk to parties best able to manage them. Under the program, the banks has actually deployed 2 relay instruments to address financing need, but also the African continent. I think under the Contour program, we have contingent guarantee issued by the bank to constructions to provide assurance of take-out upon completions. And then the relay components, which aim as a taking over the construction facility so that the burden is not really on the promoters. Under our Contour program, the bank has disbursed more than $200 million to support development of hotel across a number of countries, both in East, West, and Southern Africa. The bank will actually increase financing toward hospitality, and as we speak, the bank has a pipeline of projects worth almost $500 million, which cover countries across West, Central, but also East Africa. I think over the years, the bank has also drawn on innovative financing mechanisms to support the growth of manufacturing and hospitalities. I think these include its guarantee program, which helps support long-term financing, while at the same time lengthening loan tenors. Our successful ECA facilitation program is also very important and fascinating to help African institutions acquire essential goods and services, the capital good that manufacturers so dearly need. And then our syndication program, which has enabled us to draw on our convening power to leverage more resources globally into the continent, achieving a leverage ratio of almost 1:8. Height of the pandemic, I think we worked with the Tanzanian government to actually leverage almost $1.3 billion into the Tanzanian economies and achieving a very impressive level ratio of 1:10 in that regard. I think through our syndication agency functions, the bank has been able to mobilize almost $12 billion in support of growth within its member countries. I think the African Development Finance Institution par excellence, the bank has also drawn on counter-cyclical support to provide time financing to African entities, both sovereign and corporate, to essentially quicken the process of economic recovery. I think through its pandemic trade impact mitigation facility, the bank provided timely financing to its clients to help them deal with acute pressure on liquidity and sustain growth, and in the process, soften the impact of COVID-19 shocks, but also create the condition for faster and prosperity post-pandemic. And the bank has disbursed almost $8 billion as part of its pandemic response. In addition to providing timely response to assuage liquidity constraint and pressure, I think PATIMFA has enabled the bank to collaborate with private sector to accelerate diversification of source of growth and export. The support extended by the bank under PATIMFA has also enabled African entities to expand processing capacity for domestic productions. We are investing now in the pharmaceutical industry as a result of that effort. To conclude, Mr. Chairman, I think African financial institutions doing enough to bridge financing gap in manufacturing hospitality across the continent to catalyze recovery post-2021. And our answer, Mr. Governor, is not nearly enough, especially considering the huge financing gap across the different sectors. and the turbocharge normalization of monetary policy by systemically important central bank, the Fed, the ECB, could actually add another challenge to what we are facing, a major constraint, at least in the short term. But still, I think overcoming, in our view, the institutional culture which assumed that this sector are too risky is perhaps the most important bounding constraint that we see, as the example of CBN, the Central Bank of Nigeria, clearly shows. The success of that experiment should incentivize both monetary authority and banker across the continent to allocate more resources toward this sector, as they are critical not only for recovery post-COVID, but also, and more importantly, for a successful implementation of the AFCFTA and effective integration into the global economies. Manufacturing and manufacture goods dominate both extra and intra-African trade and could put countries across the regions on a long-run path of fiscal and debt sustainability. Afreximbank is supporting the process of export diversification, working closely with its trade finance intermediaries and drawing on its convening power to leverage more resources into the continent. Again, and to quote John Maynard Keynes to close, the difficulty lies not so much in developing new ideas as in escaping from the old ones. I think together we can escape the colonial development model of resource extractions to become a powerful force in the global economies in the post-COVID era, dominated by the increasing quest for more resilient global supply chains and implementations of the AFCFTA. And on behalf of Professor Benito Rama, we would like to thank the Uganda Banker Associations and all its members for welcoming Afreximbank last month. Thank you very much.
Thank you so much, Mr. Hippolyte Bofak there. Any questions, concerns, or comments? If you just raise your hand, I might get to you. Anyone? For now, you'll keep your thoughts. I guess at the end of the first panel, we'll be able to have all those created. Thank you so much for that presentation. And great quote there. The difficulty is not in the new ideas, it's in the old ones, holding on to the old ones. Ladies and gentlemen, a big thank you to our keynote speaker. Thank you so much, and for highlighting, it's not just for Uganda, it's for the entire world. The problem is not ours alone. I'll give you a chance to. I'll just check again. Is everyone okay? Do we need a break? Yes? Do we need a break? Oh, wow. Here I was about to put you into some deep conversations. 2 minutes? 5? 5 is safe, yeah? All right, so it's 11:04. In 5 minutes, we'll come back. Deal? All right, the 5 minutes start now. While you're at it, there's an exhibition center outside, so you can actually use your 5 minutes. If you sneak in an extra 2, I'll not actually bat an eyelid. So yes, the exhibition is outside for all our partners and our sponsors. Take a peek. Good morning. Good morning, ladies and gentlemen. I believe we will get settled now. All right. I think that break was quite necessary because I can now hear a few voices raised and amplified, which is great. Just to remind you, we do have exhibition booths. If you've made your way down there already, fantastic. If you haven't, not to worry. For 2 days, they'll be here. And also at the end of the day, you'll be able to at least have a moment. So our hashtag is BankingConf22. Remember that we were tasked by the PS that these are not conversations that are just going to be you talk, talk, talk. We want to task you with implementation and work hand in hand with government, of course, to make sure that these conversations come to life. I will be handing over to someone else for this next part because they'll be hosting our panel and our conversation next. There'll be a Q&A session at the end, so keep back. Thank you so much for a wonderful keynote. A big thank you to those who've been with us for a long time, the entire time the bank of 2017, MasterCard. And speaking of that, eyes to the screen for something about MasterCard.
Of all the numbers that matter in business, here's the one that matters most. 7.7 billion. Because that's how many people there are on this planet. So every day, we work with banks, merchants, businesses, cities, and governments to solve human needs with human ideas. Every capability we build on, every investment we make, and every partnership we enter into is driven by MasterCard's mission to improve people's lives. We helped make life a little better for everyday commuters by introducing contactless technology in transit systems worldwide. We're creating a more seamless checkout experience for online shoppers. We've developed new digital-first payment experiences, helped Lyft drivers thrive in the gig economy, made it easier for people and businesses to move money around the world, made transactions of all kinds safer and more secure, developed new artificial intelligence solutions that work for people, extended the reach of our real-time payments, and continued to pursue our vision of a global economy that works for everyone, everywhere. And we redefine the look, the feel, and even the sound of a brand that touches the lives of billions of people all over the world every single day. At MasterCard, we are here to help our partners help people, because we believe when you start with people, you can start something priceless.
Fantastic. And just like Mr. Sharia Ali had mentioned, MasterCard does everything with passion. Ladies and gentlemen, I thank you for the most part of the morning. You've shown me nothing but utmost respect and love. You will do the same for the next person who will be taking you for this particular one. He'll be hosting our panel and moderating. And for every other question or comment you might have for the next discussion, he'll be taking over. Please, a warm welcome to Paul Busharizi. Same love to him.
Thank you, Flavia. Pleasure to be here. Paul Busharizi. My day job, I'm a journalist with a New Vision, business journalist. And when they asked me to moderate this, to come to the Uganda Bankers Association conference to moderate, I said I came running. Because a wiser man told me many years ago, when bankers are in a room together, they're conspiring against the depositors. I want to be in this conversation. Unfortunately, I have had nothing, no conspiracy so far. So I'm hoping, maybe you guys will forget I'm here and, go about your business as usual. Jokes aside, we're dealing, I've got a panel of some very serious people. We'll be discussing the multiple role manufacturing plays in promoting growth of SMEs, job creation, regional trade and diversification, and the specific efficiency and funding challenges constraining this role. It's a bit of a mouthful, but I think my understanding is how do we activate manufacturing to play its rightful role in our economy. The previous speaker was very good in listing some things, but we're going to get some real local content from our next panelists. So I'm going to call to the stage, in no particular order of importance, my panelists. Let me start with Ms. Winnie Lawoko Olwe, who is a director of domestic investment at the Uganda Investment Authority. She's done a lot of work in this country. She's worked with several serious companies, the Sheraton, MTN. She's the first country manager of the East African. But in her own right, she's a business lady. And of course, she's, as I said, in Uganda Investment Authority. Welcome to our stage, Winnie. That's the beauty of being the first one. You choose wherever you want to, wherever you want to place yourself. Next is Mr. Moses Kagwa, who is a Director of Economic Affairs at the Ministry of Finance. He needs very little introduction. I've known him since he was dealing with taxes, chasing shopkeepers when they were trying to introduce VAT, if I'm not wrong. So he's been around a long time. When VAT was introduced to Uganda, of course. Welcome to our stage, Moses. Next, Mr. Francis Kamulegea, who was, I think he will correct me if I'm wrong, but the immediate former managing partner at PwC. When I saw him, I said it's a bit too early to retire. When you look at the both of us, it looks like I should be the one retiring, not him. But yes, Francis, he says he's transitioning. He prefers the word transition. So he's transitioning to other things, of course, business. And then finally, but not last but not least, Mr. Richard Mubiru, who is the corporate affairs manager at Pickfair Group of Companies, but he told me he's here in a much larger capacity. He's the chairman of the board of on the economy at the Uganda Manufacturers and Policy Affairs at the Uganda Manufacturers Association. Welcome to our lady and gentlemen. Give them a round of applause. Might get them to realize their obligation to us to talk sense only. So what we're going to do is I'm going to ask you to, each of you, I think I'll start exactly like that, questions. So I'll start with you, Winnie.
Good morning, everybody. Mentioned at the beginning, but allow me to say thank you to the Bankers Association for inviting Uganda Investment Authority for this very interesting conversation, and yet having a huge bearing on the future of Uganda and its dynamic position within the Great Lakes regions of Africa. Manufacturing. I think one of the very interesting things about manufacturing is it touches a number of areas. Manufacturing touches the human resource, touches on labor, touches on land, touches machinery, and everything that is happening in this fourth industrial area, seasons. Now, before the multipliers or even dive back into what UIA is doing, there are critical points that we should be looking at, identifying the data silos. And I think when we talk about identifying the data silos, we are talking to the right people here and the right people that need to look at those data silos. We all have on data, but how are we taking it forward to enable us to move away from what Exim Bank says, the old ways, but move to the new ideas, the new ways of doing things, the new ways of tapping into the sector that is going to give us that jump and not a leap. The second thing I want to bring to this conversation is effective looking at the supply and value chains and long-term thinking. The other thing I talk about is the logistic framework. I think COVID-19 was the real test of how well your logistics are planned. How do we transition the manufacturing sector to say we are in a position where we can be able to meet the... But when the PS was talking, I just kept listening to all these demands that have been placed on the table. But we are not able to quickly mobilize resources to be able to meet those demands for the China market and all the other markets she talked about. The other two things that I want to talk about in discussing this issue is the leverage of business analytics, the Internet of Things. How are we playing in that area? Continuous product demands. Today we have the war between Russia and Ukraine. Have we taken that ability to say, what is it that is going to replace the wheat? We in Uganda do have that. We have cassava, we have bananas, and we have the sweet potatoes. Those are gluten-free. Very short time in discussing this, looking in this sector. I think it would be interesting for us to note that in the last financial year, the licensed planned investments totaled $6.9 billion US dollars. And of those $6.9 billion US dollars, 3.2 of them goes to the manufacturing sector, and the 1.6 goes to the mining. The rest is divided in the areas. Now, when we talk of mining, we also know that part of manufacturing takes raw material from mining. So those are very critical areas, and it's a very important discussion for us. In servicing the domestic investor, which includes the SMEs, we've really realized that there's a huge disconnect between the financing sector, the ability of the SMEs to actually bulk, and also the ability of MDAs to service. And under the NDP3, Uganda Investment Authority has been given the green light to create an SME portal. We call it an SME portal, but this is an SME platform that is going to profile SMEs across the country and begin to look at agricultural credit scoring and SME credit scoring, so we can begin to address the critical points that need interventions. And this is going to be an evidence-based platform that allows us to be able to look at the ecosystem players and also begin to look at where the markets are, where the gaps are, and begin to address that through data. The second thing under the NDP3 is the development of industrial parks. We have bankers in this room. In terms of the industrial parks, we have the government or the public industrial parks, but we also invite public-private partnerships. For the public-private partnerships, if you drive along Ginger Road, you will see a number of private-public partnership industrial parks that have come up. And indeed, you will begin to see that that is a game changer in terms of jobs created, but also in terms of opportunities for new products. Now, lastly, as I sum off for this discussion, it's important to note that Uganda, local investors were the leading investors within this $6.9 billion that we are talking about in terms of licensed investors. Uganda grew by 100%. And why was that? It's because of the deliberate efforts to start seeing how Ugandan markets can begin to move into manufacturing and production. But the question is, are we giving them development loans? Are they able to access development loans that can allow them to develop without stretching themselves beyond what they can do? The second is, are we looking at those clusters that can cascade the development in this country. Thank you.
Thank you very much, Winnie. I'm particularly intrigued by the mention of data silos. We probably will explore that a bit more. But let's come to you, Moses. The perspective from the government. You've had all this. What's your take?
Thank you so much, Paul, and good morning, everybody here, honorable ministers, the deputy governor, I've seen you there, and all the captains and CEOs of industry. One, as government, of course, we take the manufacturing sector seriously, and we have seen it developing, moving from its contribution of 13 to 15% of GDP. It's a very large consumer of our electricity at 66.7%. It employs over 1.3 million people. It contributes to about 18% of our total exports. And then it gives us revenue, tax revenue of over 15%. So it is recognized, of course, in the NDP as one of the programs that will help us in economic growth. And the NDP has a lot of targets to increase manufactured exports to total exports, increase industrial sector contribution to GDP, increase share of manufactured jobs to formal jobs, and then increase the labor force. So we really take it very seriously, but we've noted, of course, that there are a lot of impediments to its growth. And one of them I will mention, since this is, we are with the bankers, is access to affordable credit. And also the mismatch between the credit that is available in the market and what the manufacturing sector really requires, because they want long-term loans with gestation period, which most commercial banks are not providing. So it is something that we are really grappling with, because if you look at somebody borrowing at 18%, what will be your margin? And the margins in this country are small. So it means in most instances that it's very, very difficult to break even when you are borrowing commercially. So it is something that I think we're discussing as government. We have tried to put more money in UDB, but it's inadequate, because UDB right now is capitalized by almost 1 trillion shillings, but then the demand exceeds that amount. We have tried to also put money in the agricultural credit facility to help especially the businesses that are in agriculture and value addition in agriculture. But it is also not yet adequate. We are thinking about having more money there. We are financing SMEs, mostly SMEs, partially through UDB and also through the Microfinance Support Center, using the circles to facilitate them. Then we have especially small businesses, which under which government is partnering with commercial banks to have what we call the Small Business Recovery Fund, to lend to small businesses. Government has provided 100 billion, and the banks, the participating financial institutions, are also providing another 100 billion. That is, that fund is being managed by Bank of Uganda. But all in all, we see that we still have limited access to financing mechanisms that can support manufacturing. We are thinking about promoting the capital venture funds so that some people can bring in capital There are issues that are related to the law, whereby either they are treated as companies under the Capital Markets Act when the favorable treatment should be partnerships, so we are looking at that. There are also issues of taxation, that there is a double taxation, and yes, so we are looking into this and see how we can remove that to facilitate that. But we have also noticed that generally the SMEs, especially in the industrial sector, are still weak and they need a lot of support. So it is an area where I think we are championing this with the Ministry of Trade, where we are putting up an industrial policy with UIA, trying to ensure that we have financial literacy embedded into almost all our projects for these SMEs to benefit. Another thing that is hurting the private sector in manufacturing is proliferation of substandard goods and counterfeits on the market. It is something that is hurting the manufacturers because they are being outcompeted. Most counterfeits are actually cheaper, and so you cannot compete against those. And one of the things we are doing as government is to try and see how we can strengthen the standards area through the Ugandan National Bureau of Standards. We are providing more funding for them to ensure that they enforce standards. We have also seen that we don't have a very good linkage between trade and industrial development. There's a lot of trading going on, but then it's not linked to industrial development. How can we start from manufacturing, and then we have the markets for our manufactured goods, and also the markets, not only Ugandan markets, but regional markets. We have the East African Common Market. We are not taking care of, we are not having full advantage of that, and we are also have now the African Continental Free Trade Area coming in. So it is, we are working with our partner states to try and see that we really have market access, but that is also going to be incumbent on the standards that we can have. Then there is the lack of a support system to nurture innovations. We've not been doing that as a country. We want to take a holistic approach to try and see how we can support SMEs which are innovating, to provide them with seed capital, and also to have them access funding. Because a lot of financial institutions don't lend to startups. So it is something that we are looking at. I think I'll stop here for the time being.
Thank you, Moses. I think the bankers, at least I'm talking from the man on the outside who's crushed this party, that access to affordable credit is something probably we are going to have to hear a lot more from you today. But let's move along. We'll come back to that in questions. Let me come to Francis Kamilegia, who can give us his perspective from his long time as an auditor and accountant, and Ugandan, of course.
Thank you very much, Paul. I've actually not been an auditor, only that I was leading a professional services firm which had auditing among its other businesses. But I like the fact that Moses has already alluded to tax, because I thought initially that I was here because of my previous life as a tax consultant. But let me talk as a Ugandan. And looking around the room, we have more bankers and people from the financial services industry than people from manufacturing. So I'll share some ideas in terms of how financing manufacturing can be done differently. 20 years ago, I was in this room with many people who have since moved on, and the discussion back then was on asset-based financing. And leasing was a very, very new thing in this country, And there were lots of people, both from the government side in terms of tax policy, regulators, lawyers, who were explaining all the reasons why it can't work and why it's very risky and why you can lend on a movable asset and you think, it is on Nasser Road, only to find that it's in Juba. By that time, you couldn't go to Juba anyway because of whatever was going on there. But we've come a long way, and very many bankers seated here know that asset-based financing is very well established in their businesses. So it requires very new thinking when you're dealing with issues that we're dealing with at the moment. And for me, I would say that for manufacturing and agro-processing, we need to embrace a new concept, and it's very successful elsewhere, especially in the Southeast Asia and India. It's called value chain financing. And it may sound really very fancy, but basically it is when you lend somebody money who is manufacturing fertilizers, you had better have an interest on where he's going to sell the fertilizers. Whoever is going to use those fertilizers is most likely going to be a farmer or somebody who produces something that requires fertilizer. And not only should you be interested because that is a potential customer of your customer, but also he's also got another customer. He's going to sell his produce somewhere. I was looking at the Bank of Uganda report, and I was very heartened to see that the lending and financing given to the agro-processing mainly goes to manufacturing. So I'm a farmer myself, and I'll tell you more about that if time permits, but not here. Maybe I should invite you to my farm. But in farming, you have the value chain. So in very simple terms, you have the production, which is at the farm itself, growing the stuff. Then you have the manufacturing, if there is manufacturing to be done in terms of value addition. Then you have the marketing. But from a financing perspective, I think when you think about the people you lend money in the agribusiness value chain, you'd have the people who supply inputs. That could be fertilizers, that could be seeds. It could even be the plant and machinery that goes to the farm. Then from there, you have the people who actually buy from them and they produce those inputs. And I call those the producers, and in my case, I would fall in that category as a farmer. After we've grown our stuff, I grow coffee mainly, we sell it to aggregators, we sell it to manufacturers, and we sell it to traders, because those are the people usually who have access to the market. And then those guys are either processors or manufacturers, depending on what the commodity is, and then ultimately that goes to the wholesalers, the retailers, and the exporters. And at times you don't need to look very far. You go into Carrefour or Capital Shoppers or any of these supermarkets, everything that is there, apart from the packaging, which is either plastic or paper or rubber, don't know if there's anything wrapped in rubber, but everything is from the farm and manufactured somewhere and sold to us. So if we're talking about industrialization in Uganda, we have to be very realistic in terms of where we need to start. We have to have a proper appreciation of the value chain. And again, for the bankers who are very concerned about the attendant risk in these enterprises, if you think about all the risks that are associated with financing agriculture or agro-processing, it's mainly due to information asymmetry. I give this guy money, but I don't even know how much yield he gets per acre. I don't even know when he processes maize meal, what goes to maize flour, what goes to maize bran, and what goes to human feed, what goes to animal feed. But I like what ABI is doing, and there are lots of other, there's a colleague of mine here from Pearl Capital Partners and various other people who have really gone out of their way to understand agriculture and the value chain. And I believe if there is that investment, it doesn't have to be done by each bank individually, but through the Uganda Bankers Association and all the other industry bodies that we have, we need to have a repository of information and then also have some experts who understand this sector so that we can stop referring to it as risk and very risky to lend to money, but understand where the money goes and where value is added, and even encourage them to do things differently in terms of economies of scale. I think if we do that, we'll have cracked a major bottleneck within the so-called, poor access to financing for the agriculture and agro-processing on one hand, for the farmers, and on the other hand, the very high-risk nature of providing funding to these enterprises. And I'll stop there for now. Thank you, Paul.
Thank you, Francis. So maybe 20 years from now, we'll be talking about how you're talking about value chain financing, and hopefully we will not have moved on. But let me come to you, Richard, from UMA. Your take on the subject?
Thank you very much, Paul. All protocols observed. I want first and foremost to salute the Uganda Bankers Association for having picked on manufacturing as the new thing for Uganda, because this resonates with NDP3, it resonates with actually our budget theme as a country. And what a nice morning to be debating this. We thank you as manufacturers for this patronage. And may I also use the same opportunity to acknowledge the fact that we are here because commercial banks have financed us for now. And it will be ingratitude not to recognize that fact. A round of applause for you. Yes, I listened in to the presentation of the chief economist from Afrexim, and I want to entirely say that as UMA, we entirely associate with what actually you shared with us this morning, and especially coming from the background that the leading exporting countries have got manufacturing sectors powered by development banks, not commercial banks. So friends, we can sit here until cows come back home, but I think basics are basics. It's Germany, it's China. One for Europe, one for Asia. We want to do manufacturing and take it to another level, that's what we must do, to begin with. Now, the next thing is, how do we restructure manufacturing financing in Uganda for now to take manufacturing to another level? I think what we have been seeing is primary processing, agro-processing, light manufacturing, dominating manufacturing in Uganda. And let me tell you, the game changer is not in that, whereas that is part of the solution as well. But I think the game changer is to focus at heavy manufacturing. And this is what Daniel previously spoke to when he spoke to iron and steel. And I will just share with you numbers. Our import bill is in the region of $10 billion. And I want also to share with you a very interesting number. 10% of our import bill is constituted by inputs for steel and clinker for cement manufacture. And the worst story is that we have one of the finest steel underneath, as well as limestone. Now, for my very good friend and a senior brother, Dr. Michael from BOU, stabilization of the currency would only need us to come up with a synergy that speaks to getting our iron ore from the ground and our cement directly from limestone. You will have resolved 10% of the driver for forex demand in Uganda. Nothing bigger than that. I could go to another value chain. You speak about textiles. Very interesting numbers. 2020, 2021, Uganda exported 90% of cotton lint and earned $29.4 million. And now the local producers of textile did add value on 10% of the lint and produce value in excess of $50 million. What do we have to do? Numbers don't lie. You will realize that a sector like textile, for example, can actually transform into $500 million in terms of value. And the sad story for this is that in the same year, when we got $29.4 million, we imported textile and textile-related items worth 256 or thereabout $million. Now, what must we do for purposes of fixing the devoid, actually? Now, the answer is in the structure of the financing that we have. To get a payback, and if you are looking at a vertical textile mill, typically, and I've been in this sector for a couple of years, I know, you require financing that is patient enough to enable you have 10 years for you to think about a return to investment. And what do we have? Average 3 to 5 years. If you are a very good bargainer, you can get 7 years. So in the end, you are not able to actually unlock the potential. The story is not any different for hides and skins. Our importation, if you looked at 2021 figures, anything in the region of almost $300 million. And what is it that we have to do? We keep on exporting wet blue. Wet blue is the primary processing that we are so far being able to do in Uganda. And anything about hides and skins, talk about bags and everything that we need, actually, shoes, etc., is imported into the country. So, friends, where we sit as WOMA, we resonate with what Afrexim observes. I think bankers in this room, you need to think of synergizing with people who are already doing it. And I want to remind you that the little manufacturing that we have in Uganda was midwifed by EIB financing, actually European Investment Bank, Apex financing. If you remember, for those of you that have been around for some time, the little strength we have in manufacturing in Uganda was midwifed by that intervention. So what you see today, the roofings of this world, as my previous colleague spoke about, were beneficiaries, and all major groups you can speak about, beneficiaries of EIB financing, where you had it long-term a little bit, and rather concessional. At 18%, really, friends, what rate of return are you talking about for you to be able to thrive? No wonder our structure for the economy is what it is today. It is what it is today because what you sow is what you reap. We are reaping exactly what we have been sowing for many years, but I like the story of what the chairperson for Uganda Bankers Association alluded to in the areas of trying to create an export guarantee scheme, and I will tell you where we sit. On average, industrial capacity is utilized up to a maximum of 67% in Uganda for now, which means that we can almost double manufactured goods exports without adding any new capex. So where we sit, we are very, very much excited about this innovation. We are only thinking that it ought to have started and been on the block yesterday, and we can only continue crying for more, but also to say that, and especially when my big brother Moses is part of this panel, to speak to trade policy. Because we're speaking financing. It's not all about financing, really, to spark growth in the economy. And for me, I think that's the big picture that we should be discussing. We have had also challenges in terms of a policy outlook that looks into the future. And I will discuss something that is very familiar with for many of us in this room. How are we performing at the EAC level? It's only Uganda that is ready to turn its chin every time actually is being discriminated against when it comes to trading within the EAC. As WOMA, we were very gratified when we had the Ministry for Regional Cooperation speaking to considering retaliatory measures when it comes to trade distortions. Because if you are in a customs, in a monetary, a common market, sorry, I beg your pardon, how come goods from Uganda cannot circulate freely across the region? You have heard of the stories of sugar, chicken, milk. The list is endless. I think this is a conversation that we can have with my big brother, Moses, to say that one of the impediments to even expansion for manufacturing is actually distortions that come with market restrictions. But I don't want always to paint a gloomy picture. They are success stories. And I want to end by sharing one of the greatest things that is happening, and to thank government for that. And this has been the very remarkable progress government of Uganda has done in terms of negotiating a new ESC CET that has started from 1st of July, that is giving us a four-band structure to allow really for vertical integration across especially extractive and agricultural value chains. I think this is something that can take us to the next level. For now, I want to pause. Thank you very much.
Thank you, Richard. It's very, maybe that's why you're the strongest lobby group, UMA. Whenever you have a chance, you'll throw in everything you've got at these people. Maybe that's why they are successful. Moses is here listening to everything you've said. But what's going to happen now is I'm going to probe some of the presentations you've made or some of the submissions you've made, and then we shall open the floor for questions from the banking public, I think we call it. So let me come to you. Let me start with you, Moses, and it's something that you had a whole raft of things that you're thinking about as government, or you're privy to what government is thinking. I think the first thing is you mentioned that businesses have a problem of access to affordable credit. Maybe the bankers have told you this before, but I hear it every time in my daily life. They tell me, but when government is borrowing at 17%, why should I be risking money with Moses, Winnie, and so and so? Anything can happen to them. As somebody suggested, you're lending to somebody in Katwe, but he's actually in Juba. Maybe you can, maybe there's a new thinking around in government to this or something. Speak to that about affordable access to affordable credit and government's responsibility as far as that goes.
Thank you. Of course, this issue of domestic financing or government borrowing from the market, and the banks playing a very critical role of financing government deficit is something that's been talked about for a long time. Of course, when you look at it from the banker's side, it is true that when government borrows and they cannot lend to the private sector below what they are lending to government. So we start from there. What are the TB rates, the bond rates, and then they add on the risk that is also found with the private sector, because they say with the risk that is there, they would rather go into the safe haven of providing financing to government. We have a plan to reduce government borrowing. And every year we really try to articulate this, because that borrowing, together with external borrowing, takes a very huge amount of money from us as government, which would have used to do other things. For me, when I look at the interest costs we are paying, 5 trillion or 6 trillion shillings, and you look at the revenues that are being collected by URA, 21 trillion this year, last year, and 25 this year, find that a very big percentage of our money goes into interest payments. So that affects us, but it is also, as far as the private sector is concerned, it affects them. That's one of the reasons why interest rates are high. Of course, the other reason, the bankers will tell you that they have about 4 trillion shillings, which are stuck in disputes, which are not being resolved. So you have disputes between the bankers and their clients, and it's taking too long to resolve them, so all that money is stuck there. And I think that is also something that affects interest rates. If the judicial process can actually be faster and these commercial or banking disputes are resolved, I think that could see interest rates coming down. The other things, of course, are structures in the banks. I think Governor could have talked about them. We should talk about them. And one of the reasons they are saying is that our banks are small. Their capital is really inadequate, and they are trying to ensure that they move away from what is there now to increase the capital requirements of banks so that they can be able to effectively play in the market. Thank you.
Okay, I'll let you off the hook for now, but we're coming back. But, okay, let me come to you, Winnie. You talked, you're at UIA and you're trying to create a portal for SMEs. You also mentioned something about data silos. But to be the devil's advocate, especially in lending to SMEs, isn't it also the case that SMEs probably don't need or shouldn't be looking for the financing that is in Uganda now? And what are we doing about changing that? The structure, the commercial bank lending, it might not be what SMEs need. That's one thing. Two, sometimes the SMEs just don't meet the basic requirements to qualify for loans. What is UIA looking at that? How can we help SMEs actually step up their game?
Hello? Okay. I think when we talk of data silos, it goes very deep because it's not only on the part of the SMEs, but also the absence of the bankers critically using the KYC information they have to single out those SMEs that can be supported and can become the mentors of other SMEs. I say this with a lot of humility. I do not want to put it that the bankers are the only ones not using the data. Even us at UIA, there was quite a lot of data that wasn't being effectively used. Now, one of the major things we've seen, it's not a new innovation. In a business environment, they tell you never invent the wheel. The wheel is already there, just modify it. So we're looking at, if we take the SME in the Ugandan sector and compare the SME with a Kenyan sector SME, who is able to get financing. And when we talk of development financing, maybe at the SME level, we are not looking at huge finances that require development space of 10 years or, even 5 years. The critical issue is, one, the issue of formalization, because before we go into the banking sector. What is formalization? Do we as a country identify formalization to the best need of an SME? And through data management, we are able to realize those SMEs that probably just require a little bit of support to formalize, and be able to become competitive SMEs to look at. The second thing that would come in is the internal environment to consume the finances that are being given to this SME. I think most times the bankers spend time looking at those things they want to hear. And surprisingly, even after an SME has passed all this, the SME may fail to pay the loan. Now, we're looking and saying that in this stage of Internet of Things and, data and traceability and all that, can the banking team work with us to be able to come up with an effective SME portal credit scoring, which will then tell you that this SME has demands for their products, has inferior equipment, has now been equipped with business development and has internal competitiveness to deliver, and then fund. And here we're looking and saying that it is not rocket science. We can do this using blockchain technologies. The SME needs effective improvement in the internal sector. Don't pay the SME. Pay Enterprise Uganda, pay whoever, work with them, and let them move to that next level. And I think for us at this stage, it would be interesting, of course, to say what stage have we reached at. We are currently on the stage of profiling. The next stage, which is within this next financial year, is the credit vetting. If I'm a small business in Kenya today, artificial intelligence allows me to be positioned whether I am worthy enough to be given an overdraft or financing for a specific area. So what we're talking about is there's enough information that can give us traceability. It can give us data analytics which tell you which products or which markets will take your product if brought to a certain level. So those are the conversations, and we are very much interested in continuing with this conversation with the stakeholders in this room. But also the other thing is we're bringing together ecosystem players. In the next 2 weeks, we are having a very aggressive stakeholder product engagement to get stakeholders to onboard onto the portal. The government has spent so much money in terms of BDS services to SMEs, but have we been able to see SMEs grow between the 1-2 years? Have we been able to see them grow between the 3-5 years? If we have not, what is the issue? Are we dealing with the same SMEs over and over again? So I think those are questions that we need to start discussing and demystifying. I hope that takes me off the...
We'll get back to you as well. But yeah, that was interesting, especially about how much data there is flying around, literally in the air, that we are not taking advantage of to make decisions in terms of financing. Which brings me nicely back to Francis, who was talking about information asymmetry, which is more or less what's happening here. But maybe also talking about your... I don't think it's anymore a hobby of yours, farming. I think now you're trying to make it a business. Isn't the challenge also in trying to finance farmers that they are not structured in a way that the banks can get an accurate view of the risk involved in financing them?
Thanks, Paul, for that. It is true the farming sector is very informal by its nature, and that is informed by so many things. One, the kind of farming that we do, because a lot of it is subsistence. Two, the land tenure system, but also the way we get into farming. For those of us who have had the opportunity to be on this other side, it kind of starts off like a hobby, and it's really something which is nice, and a few celebs in quotes are doing it, and then they post on social media, and then it looks cool. But actually, you ask them, are you making money? And they will never answer that question properly. But having said that, there are some very, very serious farmers out there, I think for proper farming to happen, some people need to leave the land and come into the city so that there is proper aggregation and consolidation of the small holding. For those people to come in the city, again, there has to be proper planning so that that urbanization does not result in urban slums that we're seeing in this country. In fact, in some countries, for you to be considered to be a commercial farmer, there is a certain size of land and level of activity, both in terms of productivity and value addition you need to be doing there. Having said that, if you use the model as a financial institution, the model you use to lend to somebody who imports finished goods from Hong Kong, Dubai, and use that model to somebody who is growing maize, millet, cassava, which is eventually going to be sold to an aggregator somewhere in Serere or Kapchora, who then eventually sells it to NBL or UBL to manufacture Eagle or Senator, and you're using that model, most likely it will not work. So it's really important that the business model from a bank and financial institutions perspective also changes, and the industry which everyone is excited about right now in terms of oil and gas is one where very new enterprises are going to come into play. Many of them are there already. They do not have the huge collateral that you're used to in terms of assets for which you want to use as security. But actually what they have is a contract from Total or McDermott, which is worth millions of dollars, but those millions of dollars can only be realized by funding from a local financial institution, because again, financing it offshore would not be sustainable. So there has to be new thinking within the banking sector, and to some extent it's there, but those who move fast and they are ready to make some mistakes, and they'll be made, there'll be a few risks, no doubt about that, but they'll make the money, but most importantly, they'll be seen to be more relevant in society, because you can't go away from that, especially with this new era of ESG. I also want to talk very briefly about the need for stability from a policy and regulatory perspective. Banking is very, very sensitive to anything that may appear to be sort of challenging status quo. Some of the things are just very well established, maybe not legislated, but they are known as the way business is done, and they've been the case for so many years. So whenever there are interested parties who come in with their own ideas to challenge the status quo, and then they have they dominate the airwaves in terms of the messaging, capital, as we know, is very, very shy. And naturally, bankers are custodians, they are intermediaries. They take money from us depositors and they lend it to somebody else, and they have to make a margin. And to use a very crude word of trading, they are also traders. So they need to make money on somebody's money that they have taken, include shareholders and depositors. They need to make a margin so that they can also survive and thrive. But most importantly, they need to ensure that they can pass that money back to whoever it is that made that deposit. So certain sectors of the industry seem to be quite easy to lend in terms of property construction and real estate, because there is a brick and mortar somewhere you can touch and feel it. Other sectors of the economy are somewhat fluid and nebulous, and you don't quite see it. But for us to make the transition and transformation we aspire to as a country, there is need for new thinking in terms of the financing of these new and upcoming sectors. And if whoever does it right, I think, even despite the few mistakes that might be made, will be on the money. But again, I would not encourage every bank to do it on its own, because it is very, very expensive. One of the reasons they tell you, Paul, about the high cost of credit in this country is the cost of doing business. But you want to unbundle that cost and say how much of that is in infrastructure, is in technology, is in NPLs, NPLs at times is even perceived risk, as opposed to the risk that has arisen because money has not been returned. But if you don't return money, it makes me more even risky, despite the fact that I've not failed to return mine. So we need to change mindset, and regulator, I don't even know what I'm saying here, but I think you have to be on this table as well, because there are going to be new things that need to be done, while at the same time ensuring that monetary policy and stability and all those things we subscribe for, we are not compromising on them in any way whatsoever. So I'll stop there, Paul.
Thank you, Francis. It seems to me that from a layman's perspective that we actually need specialized banks, people who to focus on agriculture or whatever the case may be, probably asking too much from our commercial banks, but I'm sure they'll say that for themselves, if not. But Richard, coming to you, I want to give you some hope that in this conference we'll also be talking about things like blended finance. They told me something called blended finance, the collaboration of commercial bank finance and development finance. We have things like green finance. So if you stick around, you might hear something that fits fits you guys at the Uganda Manufacturers Association. But that aside, you made some interesting points about where we are losing opportunities. I mean, like we have an import bill of 10 billion, and 10% goes into inputs of steel and cement, producing cement. I was wondering also, coming off Francis's comment on value chain financing, that isn't it possible, maybe speaking from the other side of the table, isn't it possible that the reason these things are not financed is the financiers can't get a good sense of, okay, fine, you will process your steel, where will you put it? It's not automatic, because there are already players in the market. We will process it, where will you put your cement? That kind of thing. Are you helping your members at least bridge those, what can you call them, information asymmetries as well, to make it more possible to lend to your people?
Thank you very much. Paul, actually I will begin by acknowledging what government of Uganda has been able to put together. If anything, we have got a very, very listening government in terms of really trying to push the trajectory that is put across by NDP 3, and of course the wider Vision 2040. Where we sit, we want to believe what government has put on table in terms of the development trajectory for Uganda, which is NDP 3. And when you look at it, two of the major pillars of this is agro-industrialization and, of course, mineral beneficiation, if you want, which then speaks to value addition on iron ore and the rest of it that we have underneath. So yes, in terms of information asymmetry, members of the UMA are aware that opportunities are present. But maybe I will speak to the missing link. Why is it that it's not happening? And in this, I want to share experience of what we see in the region against the backdrop of the fact that we have a PPP policy and law actually in Uganda, and a very generous law relative to what the region offers. Speaking to this, and I stand to be corrected by my brother Moses, we do not have, for example, a pipeline of projects. Yes, NDP has made a catalog of the projects that we must undertake for us to move to the next level of growth. But I think it doesn't end there. You must go a little bit higher to say that, yes, under NDP 3, what is it that we can create as a pipeline, because the PPP Secretariat sits at the Ministry of Finance. The Ministry of Finance, National Planning Authority have midwifed the NDP3, and therefore they know what it is that we must be doing. I think critical as a country, we need to know that there are areas where markets have failed, and if there is market failure, must government continue to just do it the way we have always done it? I don't think so. And the argument I'm putting across Paul, not mine at least. I think it was mine, sorry. Yeah. And it's detracting me, technology is always about, doing some of these things. The point I was making is a pipeline of projects that can change our development trajectory, looking at growth sectors. In this, you are then able to say that, okay, I could hear what my sister was saying from Investment Authority, the frustration SMEs have, and I can also tell you that 70% of membership of WUMA are SMEs. So if you are to talk about being able to add value onto limestone, you need to leverage the Uganda Development Corporation, which is already in place. But unfortunately, what we're seeing in this country is that deals are being negotiated by Parliament, and I don't fear to say this. I think that the deal that has just been negotiated last week in this town is a good deal, as a matter of principle. Busharizi, I know that you know this deal. I'm talking of the local deal. That is a good deal, but it could have been negotiated better. And why do we see Parliament doing what it doesn't have really the expertise to do, is that we have failed to create a pipeline of projects where you then let the UDCs of this world, where you have human capital that can structure deals, do some work in terms of vetting. At that level, you will be able to attract private sector investments at a strategic level where markets have been failing. So for us, Uganda is not taking advantage of the infrastructure in terms of legal and legislative framework that it has created. In countries like, I could even mention Zambia for now, when you land and you go to a PPP Secretariat, you will know how many of projects are available. In Uganda, you read about deals in the newspapers, and the rest we all know. I think that as a private sector player, we deserve better than this. I know that our government can do better than this. And the only way to do better is to say that where actually market forces have failed, let institutions that you have established to do investment take the lead. You will not actually be discussing many of the stillbirths that we have had in various sectors across the board. I can pause that for now.
Thank you. Thank you. Thank you. Thank you, Richard. Now, we've got a bit of a challenge, time-wise, so I would have loved to continue with this gentleman. For me, it's like a journalist's dream to be with all these four here, lady and gentlemen. It's a dream, but I would have loved to hog the space, but we have to move on. So I think what we're going to do, we're going to have a question and answer session. We will take a few questions. Please direct them to the specific panelists you want to answer the question, or if it's general, please say so. We'll take a few, maybe I think we'll take 5, the answer, and then we'll see whether time allows for another 5, and we'll go, because there are other issues, there are other panels that have to come after me. So do we have a microphone that we can, yes. So I think, put your hand up if you want to ask a question. There's a gentleman right there who's very quick. And yes, after that, gentleman, there's a lady right in front here. Please give us your name and then question or comment and direct it to whoever you want to address it.
Thank you very much for that elaborate presentations. I'm called Biambweni Peter, the head of Citizen Mass Campaign East Africa 2030. My question goes to Moses. Talk about the regional market. You said that Uganda has not taken advantage of the regional market due to many challenges, and actually you mentioned even the standards. So, but also I will combine it with the availability of the products that we produce to satisfy the market. Do we have already harmonization of policy to ensure that can deal with these challenges? Because when you look at the Common Market Protocol, it is now 11 years ago when we signed it. And why is it that we still have these challenges? And what your country, Uganda, what has it done so far? And then also, the gentleman on the left at the extreme end from Uma said that the goods are not moving freely. I strongly believe that when you go to Kenya, these trucks, our trucks cannot move freely due to the levies that are on these counties in Kenya. Not only in Kenya, but also in other countries. And think to diagnose that, to subscribe that, in order to get right medication of that, I think the body from the Secretariat at the East African Community should be the responsible to come and solve those issues amicably. Thank you very much.
Thank you, Peter. We want to keep this short and tight, so let's restrict our question and move along. The lady right there.
Thank you, our panelists. Good afternoon, ladies and gentlemen. My name is Blessing Omcha Immaculate. I'm the Acting Secretary General for Uganda National Chamber of Commerce and Industry. My question goes to Moses. For over now 20 years, we have identified that the challenge is affordable finance. We appreciate that the government has gone ahead to provide financing in development banks. But the challenge is we would like to understand how the SMEs, because when we talk about SMEs, we know the range of SMEs in Uganda, how they are able to actually benefit from the financing that is put in the development banks. The criteria that is put in place does not accommodate our SMEs to actually afford that financing. When you look at the expected turnover, vis-a-vis what our SMEs actually get, it's totally different. When you look at our mandate for the development banks, my God, they're almost behaving like it's a commercial bank. So how do we distinguish from the commercial bank setting with the development bank setting so that our SMEs are able to access the available financing that we are talking about in this bank? Thank you so much.
Thank you. We have any more questions, comments? There's a gentleman in the back there. Yes,
thank you, moderator. My question goes to Moses. Of course, it's very rare to get these very important people. So I get this.
We didn't get your name. And
my name is Ian Rumanyika, and I head external affairs at Uganda BATI. As the manufacturing sector, one of the challenges we are facing is individual organizations or companies that circumvent the process. And yet we have representation at UMA and go directly to government to probably push policies that they are interested in or favor them. And the challenge, and I speak for so many manufacturers, the challenge that does is that it affects the goodwill the investors have in Uganda. And this doesn't happen in other member states. But the individual companies go ahead and push for favorable policies and circumvent the process. And the UMA is left toothless because it represents all manufacturers. And that affects the goodwill and the purpose of us as manufacturers investing in this country. Thank you very much.
Thank you, Ian. The Honorable Omach right in front here.
Thank you very much, moderator. Winnie, the Governor Bank of Uganda has increased the central bank rate from, I think, 6.5%. Is it now 8.5? In order to fight inflation. Now, today we are emphasizing affordable credit to manufacturing. Would you like to do something about fighting inflation in Uganda through your authority giving water for production to small farmers? Because one of the things that causes us to have inflation is food security. Can you give water for production to these small farmers? And once there is water for production, I can assure you the banks will be in a position to finance these farmers. The second related to that is what I think Richard talked about. The banks that are here are ready for going into syndication of loans. But Richard was talking about emphasis on development financing, development banks. Now, could you, Moses, I'm happy to see you here, say something little about domestic capital formation, and in particular look at areas of the Capital Markets Authority and what you are doing to ensure that the rate at which the National Social Security Fund is lending to or participating in the economy can be at a reduced interest rate. And finally, moderator, again back to Moses. Dr. Hippolytus talked about dependency on manufacturing inputs, and that's for the whole of Africa, Uganda inclusive. And also Richard has talked about 10% of whatever is going into the manufacturing is out of the inputs which are actually available in Uganda, like the steel, like the one in the textile industries. Could you, Moses, as government, do something about financing this so that we have import substitution in regards to these inputs? I thank you, moderator.
Thank you. There was on the same table. Okay. So next round, there's no one from this side. We are all on this side.
Thank you very much. My name is Ben Eyabu. I'm the head of credit at Ugaford Microfinance. First and foremost, I would like to appreciate the direction the discussion was taking. That is value chain finance. Having been in the industry, the banking industry for some time, I strongly believe that value chain finance will be the magic one on the way financial institutions will intervene. Now, it's just a supplement to the discussion. How do we take this forward in terms of action? I strongly believe that there is need for government to synergize with the financial institutions in a very deeper way, but also play the great role of identifying which specific value chains can we synergize on and can impact on the economy in terms of driving growth. I can give an example of cotton. Some years back, Uganda was one of the leading cotton producers in the world. And when you looked at cotton, the value chain was very developed right from the stage of inputs to production, to ginning, to produce lint, and lint to produce spines, spines to fabrics, textile fabrics. All those industries were well connected, and government was developing every actor in that value chain. Now, what I'm suggesting is that we need to get back to the drawing table. Pick value chains that can impact many parts of the country in terms of economic activity. And then let the government play the role of developing that value chain right from the initial stage to the export market level, by ensuring that instead of having so many interventions that are so good that government is doing, we're not saying that government is not doing anything, but we need to pick one thing which will impact on this country. Tanzania has picked rice and is positioning now as a basket of rice in Africa. Turkey, for instance, picked cotton, and now they are the leading producers of textile apparels in the world. All the men here, 50% if you count, they are putting on Turkish clothes. So to me, the takeaway is we need the Uganda Bankers Association to form a working group that constitutes the government, constitutes the financial institutions. We go into a serious discussion, pick the value chains, and synergize on how we can intervene in terms of financial services. Value chain finance, every financial institution is doing it in its own way, but in a very disorganized way. And it's, sorry, I'm taking a lot of time. It's a financing where you need to really understand the actors. One financial institution alone cannot do anything. I submit.
Thank you very much. This is a, I'm sure everywhere we go, this is a huge discussion. Let's focus on one thing and do it, and then everything will go. Fortunately, we're a democracy, but maybe, Moses, I think Moses is the man of the hour. You have a lot of questions on your plate. Let's start with Moses. Winnie has one.
Thank you, moderator and members. I hope these are my final questions, because we had 4 panelists and they raised so many issues. So we should have really been balancing the boat. But that said, yes, thank you so much for the questions. Peter, you talked about regional markets, and we have products that are available for export to the regional markets? I will say yes. Sorry?
That the movement is being hindered as well.
Yes, I will say yes. In 2 ways. One, Richard told you that the capacity of manufacturing in this country is underutilized. We have, if at all we had market access, would have exported some of this excess capacity. So then we have the products like milk. You know, there's a time, actually even now, Kenya had stopped our milk, our powdered milk, from getting into their market. They stopped our eggs from going there. They stopped our juices from going to their market. They also stopped our chicken from going there. And Tanzania also had some barriers, the non-tariff barriers, where they were saying if you are to bring anything here, this is what we must achieve. You must pay more money than what actually you pay when you are a Tanzanian. So what have we done? Unlike what Richard said, that let's retaliate, we have decided to take a diplomatic approach. And it's starting to bear fruit because we agreed with Kenya that we also had some some tariff barriers. We can't blame Kenya alone. There are some goods from Kenya which we are attracting excise duty, like beer, like juices, like furniture, when that was not applying on Ugandan goods. So we had meetings and we agreed that we remove these discriminatory taxes and regulations so that goods can move, effective 1st July. Of course, sometimes in Kenya, right now because of elections, people put in certain challenges. They go to court and put in challenges just for that sake. But we are moving as East Africa to remove all these bottlenecks. And I think the president was in Arusha recently, and they were talking about the progress of the common market. And some of the issues that were being discussed was to remove these few remaining tariff and non-tariff barriers. So once we have standards which have been agreed upon as East Africa, those ones we are following. So you should see more trade, more free trade moving between our partner states. Immaculate on affordable finance as a challenge, how to benefit from financing from development banks for SMEs. That's a big challenge, but not only from our banks, but even if you talk to commercial banks, even if you talk to NSSF, they are really trying to nurture SMEs so that they can get affordable capital. One of the challenges is the way the SMEs in this country do conduct their business. They don't conduct their businesses professionally. And even with the business development services that we have been having, they have not really complied, having books of accounts, separating ownership. You know, they are the directors, they are the shareholders, they are the managers, so that there is no clear distinction among business lines. Those are some of the challenges. They don't have books they are keeping so that the banks can base on these books. They don't have business plans where at least somebody can see that this company, if I lend them money, they will be able to return it. Those have been some of the challenges. And we have not left it at that. We are working on the harmonized, what we call now a national business development strategy to try and ensure that these SMEs can actually develop and get access not only to financing, but even to government business, because you can't do government business with government unless you are formal. We have realized that some of them are formal, partially formal. When you look at their taxes, you say, have you registered? Do you have a TIN? No. Have you ever made a filing? Nothing. So they become informal in that regard. But we are working on the business development services to try to really address some of these challenges. Ian, you raised the question on companies that circumvent the process. There is a process that we all appreciate, that people go through UMA. But we cannot stop an individual company from approaching government if they have some issue that they want addressed. And I think Richard can attest to this, that his companies have also come to us, not through UMA, but as individuals. And we listen to them. So please, if there is an issue that is not addressed through UMA, we'll listen to it. But we always also encourage afterwards, as government, before we make any policy change, we usually invite players in the market to come and listen to us. I'll give you a very live example. There are companies now that are manufacturing industrial sugar in this country. And they said, protect us, don't allow the consumers, the manufacturers who use sugar, to import it from outside at reduced rates because we are doing this. Those included the manufacturers of beverages. So what we did, we met with the two parties and said, this is the proposal. What are you saying? And we reached an agreement. So government doesn't just say, I've listened to this one, I'm not going to listen to another one. Honorable Omach, one question I don't know it is supposed to have been answered by me by fighting inflation, but inflation targeting is the mandate of Bank of Uganda. One of the, yes, it's a constitutional mandate to ensure price stability. So they should be the ones to actually talk about that. But since you gave it to her, yes, I'll allow her to answer. And then domestic capital formations. We are working together with capital markets to see really how we can mobilize capital through capital markets. One of the things we've done is to try and say, why don't we have companies where government has had some involvement listed on the stock exchange as one of the reasons. Why don't we force companies that have got incentives from government to also list on the stock exchange? Then we are also trying to work out with them, as I said, capital, private venture capital. That is one area that we are working with them to see how we can improve the regulatory environment so that we can attract venture capital in this country. On financing of steel and textiles, of course, right now we are looking at our banks which are not yet adequately capitalized, but we are also looking at some other incentives that we can give these sectors if we cannot give them financing. So we have a number of companies which have shown interest, especially in iron ore smelting, and we are working with them and seeing what other incentives we can give them other than financing so that they can move. Finally, Ben, on the value chain finance, government to synergize with financial institutions in a bigger way. Yes, when you look at the NDP and what government is focusing on, and then the policy on the products that as government we are looking on especially agriculture, what are we looking at to really focus? We looked at 9 products, but Cabinet told us to look at 13 products. But these include coffee, it includes tea, it includes dairy products, cotton, it includes hides and skins, it includes cocoa. So there are a number of products that we are looking at, and we are really concentrating, right, moving from the value chain. Thank you so much. I think I've attempted to answer most of the questions.
Thank you very much, Honorable Omach. I am not going to attempt to dive into BOU's inflation, but I think you raise a very important component of UIA's mandate, that is an enabling environment in terms of ease of business in the production sector. Before I answer, I just want to share, last week I think we are discussing with millers across the country. We're just having discussions. And what came out very clearly is that a number of millers cannot now sustain their production lines. If you are a miller that is milling over 5 tons, I think, of maize, as long as you turn on your milling machine, the cost of electricity alone limits you to milling on certain days only. So I think one of the things that the NDP3 prescribes very clearly is that Uganda Investment Authority is to look at 25 industrial park areas across the country. The industrial and business parks are supposed to be created in such a way that they are serviced. That means you have the water utilities and the utility areas sector well established to enable negotiations for preferential costs in terms of utilities. Now, the other thing which is happening is under Ministry of Local Government and Ministry of Finance are looking at really the critical investments within the local, the local government settings. Now, we cannot work in isolation. We have the Ministry of Lands and the National Physical Planning Authority. I think it was in 2006 or 2005 when Uganda declared that Uganda was a planning area. Now, what does that mean in principle? It means that each local government is to zone areas. Where are the areas of the industrial areas of their regions? And that then allows for things like, you know, the utilities, water, electricity, to be put in a specific zone. Currently, as it is, yes, indeed, and especially being a woman, I feel for the women who are actually doing a lot of production by way of cottage industries. Now, one of the major costs they have is the water component. So it's business working. We try as much as possible to see how we can allocate space for SMEs within the industrial park so that as SME clusters, they can be able to acquire land and have kind of shared, you know, opportunities to be able to address that. That is what I can say at the moment. But I know that under NDP3, the program area of manufacturing have looked at some of those issues of provision of water, provision of irrigation in certain specific areas to enable that the production area is balanced by government interventions. Thank you.
Thank you, Winnie, for that one. Unfortunately, that brings us to the close of this panel discussion. We'd have taken more questions, but we're running out of time. If you have a copy of our program, you can see how far behind we are. I fear that my friend is becoming a politician.
No, I wanted to make a very, very brief comment. At the beginning of the conference, we had opening remarks from the PS, Minister of Trade, Industry and Cooperatives. And when she was explaining the story about the investor who went to Tanzania in rice, she made a remark that to invest in Uganda, you have to go to State House or something like that. I think that is not correct. I've already sent a message saying I'm going to make that correction. So you don't need to speak to the president. In my view, I've advised so many investors, and I think Winnie will attest to that. And it's very, very important that as leaders here, we maintain and protect the independence of institutions in this country, because if that narrative is allowed to continue, then that is what goes on the street. I just wanted to make that correction. Thank you.
Thank you. Thank you, Francis. And Moses has also thanked you through me. So, thank you. This brings our panel to a close. Thank you very much, Richard, Francis, Moses, Winnie, for your time. Give them a big round of applause. I think they've more than excelled on the subjects. Of course, this is a subject that can never end. We could have been here the whole day. We could have a conference on this subject alone, but unfortunately we don't have that luxury. I've been Paul Busharizi, your host. Until the next time, maybe, who knows? Flavia can give us what's coming forward.
All right, thank you so much, Paul. Can we agree that the sitting has been a bit of sitting? I don't know if Paul still has a bit of energy to take us through a bit of a stretcher. So if you stand, we'll do the same. Stand and let's see if we can do the same. There you go. Let's all try and stand. There. You're still alive. You still have your limbs. Thank God. Yeah? Because I'm about to put another panel on, and we still want to have our thinking caps on and be able to ask a question or two. So I'll let the panelists and Paul lead off. And as we prepare for the next panel, ladies and gentlemen, you can find your seat. There's a video going to play as the other panel members come, and I'll be able to tell you who. There's a video playing. What I'll do, because I'm very generous with my time, if you want to crisscross from table to table, I'm timing you. 2 minutes this time. 2 minutes it is.
Introducing the Raxio Data Center, the first of its kind in Uganda. Nestled within the Kampala Industrial and Business Park in Namave, Kampala, Uganda, the Raxio Data Center will enable businesses in Uganda to leverage their data to create new opportunities. As the country's first Tier 3 carrier-neutral colocation data center, Raxio is designed to host critical IT equipment that businesses depend on. Equipment that will be housed in an optimally controlled environment and monitored by our team of experts.
We are a certified Tier 3 data center. This means 98.98 availability. This also means we are only allowed 3 hours downtime in which to either fix, repair, or take something offline. But not to worry. While all this is happening, your equipment and systems are still running on our backups.
We have partnered with the leading data center designers to build a facility that will deliver highly efficient cooling, resilient power supply, and unraveled connectivity.
We are getting 2 power supplies coming from 2 different substations. In the unlikely event that both power supplies will not be available, we have deployed standby generators which act as a backup in the event the UMME supply is unavailable. So these standby generators also work in 1+1 mode, or primary and secondary, so they back up each other.
Your business is important to us. That is why we have ensured unmatched security and internationally recognized operating protocol. You will have peace of mind knowing that your equipment is under the best of care.
Data is the new gold, and we at Raxio understand the need to protect it. From the physical security, outside the building we have HD cameras, we have our guards that are always monitoring the facility 24/7. And when we come to the building, all our doors have access control, and when we come to the data hall, every door is protected by biometrics, which means only our team of engineers can access it.
Where the magic happens is in the Raxio Data Hall, which will house up to 400 racks. It will offer flexible scaling options with a range of power densities and connectivity to fiber, mobile, broadband, content distribution networks, and cloud service providers.
Data hall is a secure environment within the data center. It's optimally controlled environment. Total capacity of 400 racks, which translates to 1.5 megawatts.
The internet is just the backbone of data centers across the globe. So to achieve that connectivity, we have partnered with 10 fiber carriers, and this brings us to the concept of carrier neutrality. We have partnered with the Uganda Internet Exchange Point, which makes it possible to localize all our content in Uganda. That makes it cheaper for the end users and improves performance.
We can also accommodate our customers in purpose-designed flexible workspaces and meeting rooms to enable you to keep your business moving. An exceptional service you can trust.
Businesses have challenges running data applications, and in order to overcome these challenges, there are 4 major constraints that have to be robustly taken care of. These constraints are power, space, cooling, and connectivity. With space of up to 400 racks, 1.5 megawatts of IT power, 12 fiber carriers with diverse routes, 7 levels of security, and Uganda's second internet exchange point.
For more information, please send us an email, sales@raxio.co.ug. Let's collocate Raxio, the data center company.
All right, I believe our 2 minutes have stretched out. We can always find our way back to our seats. If you found a new friend on a new table, that's also allowed. Just to recap, we are at the annual Bankers Conference. It's the 5th. And our partners, Raxio, of course, who are talking to us about how data is important in this conversation. You had, I guess it was Winnie who was actually mentioning about it. We have FINCA, BPC, ABI. The conversation on agribusiness will definitely be happening. I guess that's tomorrow. You also have Afrexim Bank and MasterCard, who've been our partners for a long time. We do have our next session coming. I'd like to invite our panelists on to the stage. I'll start with the managing partner at Pearl Capital Partners, Dr. Edward Isingoma. Please join us on the stage. Our next member on the panel will be Mr. Richard Wairegi, Manager for Export Development Finance at Afrexim Bank as well. Please. I'll also invite the Chief Executive Officer for Uganda Insurers Association, Mr. John Antisache, to join us. The Executive Director for Equity Bank as well, and that is Mr. Anthony Chituka. And to lead this session, who will also be talking to you about the topic for this session and lead you through the rules of engagement, is David Ofongi. A round of applause as we welcome him.
Hello, hello, hello. Good afternoon, everyone. I have the most unenviable task of following Paul Busharizi, an accomplished and distinguished journalist who specializes in business. I guess there's a bit of envy to go around, unenvy to go around because I stand between you and lunch. You've had this before at conferences. I think the third component of the big challenge is that our two panels have a lot in common. I believe Paul has encroached on my turf a little bit, illegally. The subject of finance was on heavy rotation during his panel, but I have on my right and to my left accomplished funders, financiers, and people who specialize in the subject of risk, pricing risk, allocating capital at a risk-adjusted price and tenure to feed into the manufacturing industry. But I'm going to try and get this a little bit interactive. And I guess one of the benefits of coming on late at a conference like this is that there's quite a few nuggets that have been spread around. I will start with what the PS said. Geraldine Sally gave us a rope in the sense that she said she would like for some of the proceedings here to inform a cabinet paper. So my panel will have a specific ask around at the end of it. Do our discussions conclude with 1 or 2 points that need to be fed into this action ledger that we need to take? Because the conversation is good, but ultimately, how does it fit into policy? Now, let me set the scene a little bit. As you all know, we've essentially come back. I think this is the first physical conference since the pandemic. And the pandemic in itself has been a gift and a curse in the sense that yes, there's been challenges in businesses, but I think the opportunity to pivot when ports are closed, airports are closed, we learned that domestic capacity in manufacturing is a non-negotiable. I think that's one thing that needs to be the emphasis of our panel. Second, I guess, is from a policy perspective, there's really an opening up of Africa as both a point of production, so local capacity, and also as a consumer base that we can tap into. And that's where Richard comes in from a continental perspective. And I think third, the bow around this box is the aspect of green finance. Sustainable manufacturing is something that the consumer expects. There are standards in place. We do have a Climate Change Act that provides for the mechanism via which funding to manufacturing or green finance can manifest in this country. So those are the non-negotiables. Let me reprise the second part of what was shared by the PS, is that this country is very heavy on policy. There's PDF documents that circulate from one phone or laptop to another. And the growth has really been subdued 2.5% year on year, according to the Bank of Uganda annual report. So my panel here, we're tasked with figuring out how we can sort of catalyze that allocation of capital. And in the panel title is the phrase value chain. So it's not specific to your balance sheet. How do we touch on both strands of the value chain? So that's the setup. Okay? Please hold me accountable to these provisions. I'm going to start with the banker in the room. I'm going to give each of my panelists 3 minutes. I don't have a pen and cassette, but I'll use my tablet to time my panelists. That's technology is something that we embrace. So I'm going to go to Anthony Chituka. He and I have a lot of history that goes way back, but I think he comes from, in his career, he's been a manufacturer in the cement space, and now he's on the other side of the transaction, writing checks and allocating funding to the manufacturers. So Anthony, your opening salvo, your 3 minutes on our theme and how, as a banker, you see us sort of catalyzing the value chain. I mean, your time starts now. Thank you.
I hope it's on right. Thank you. Thank you very much, David, and I want to thank UBA, the sponsors, and everybody else who's been involved in this momentous conference. I mean, the theme, financing gaps, bridging financing gaps in manufacturing, agribusiness, tourism, to catalyze economic development and recovery and resilience. I think to avoid sounding like a politician, we have to just be real and alive to the challenges of the country, of the region, and of the world today. It has been mentioned time and time again, COVID, now a geopolitical crisis somewhere in Europe, and the world has changed. And the word I don't really see there, maybe it's captured as growth, I think is resilience. And that is, we must recover and we must be resilient in this new abnormal. And one of the things we're thinking about as a country is using whatever resources we have. And agribusiness, manufacturing, and we have been blessed with tourism as the tools. So as a banker, we're going to ask, or as bankers, we ask ourselves, what are we doing in those spaces? And as the PS mentioned earlier this morning, Professor Kwesiga has a very interesting quote. Professor Kwesiga says, in Uganda, we celebrate the process of planning. We don't celebrate execution. Now, in commercial banking, if you don't execute, no dividends, no bonus, no salary increments. So there's a very greedy perspective towards execution. There's a hunger to execute because we put alignment of interests of shareholders, alignment of interests of staff, alignment of interests of customers. So as I look at this theme, I'm thinking, how do we bring all that to bear? How do we understand those challenges? How do we frame something that can be executed? I mean, I can talk about my organization, and we are doing a really bold plan. And I think my group CEO was here a few months ago talking about the Africa Recovery and Resilience Plan. And what that does, it's 5 pillars, really. First one is food and agriculture. How do you enhance scale within food and agriculture? How do you organize yourself as a region because now we can't keep depending on food from outside. 2, if you're produced that you've moved from scale, you've improved output in the farms, how do you ensure that you add value? That means manufacturing and logistics. And there should be focus on that, and that is a big theme of this conference. After that, how do you ensure you can transport and move everything required to help these economies grow, be it in oil and gas sector, be it in the health, education sectors, be it in telecommunications? 1 more minute. After that, how do you ensure that MSMEs are plugged into these formal value chains? You've created value. You've enhanced capacity at food level, you've enhanced manufacturing logistics. You've asked yourself, how are MSMEs going to be plugged in? If everybody is in, where are you going to sell? So your last part is trade and investment. Do you have markets, locally, globally, regionally, internationally, to do this? And finally, how do you ensure that the bottom man, social transformation, the micro person is involved in this process? So I do hope somewhere along today's discussion, we'll be able to address all those issues. Thank you.
Thank you so much, Anthony. And I think there's 2 important points you bring up as I bring Edward into the conversation. One, we can't ignore the agricultural value chain in terms of giving thrust to our manufacturing industry on one hand. And then there are policy surrogates that creep up. I think parish development model is something that was constructed post NDP3. So how do we weave it into that SME segment, much of which, as the bankers will attest to, is informal. So you have policy that deals with a very formal structure of business that is compliant and everything else, yet the bulk of our agriculture is in the informal side. I think half of our GDP stems from that. 80 to 90% of our employment is from that space. So how do we speak to it? And I think one of the interesting dynamics within the financial realm that onboards these actors is private equity. Edward Isingoma walks the journey with his investees. When they cry, he cries. When they celebrate, he celebrates. So it has a very unique but complementary perspective to the banking conversation, particularly when it comes to manufacturing. So Edward, your 3 minutes starts now. Thank you.
Afternoon, everybody. I can only speak very little in 3 minutes, but I will try. I lead the team at Pearl Capital Partners. We've been at the private equity venture capital space for now 17 years. It's been an exciting journey. We decided we would not be bankers, and we don't even try to attempt to be bankers. We do run through each other. A few times I've been in a few bankers' boardrooms, sometimes to defend agribusinesses or positions or restructuring facilities for our investee businesses. And one thing I must say in common is that we've come to a conclusion that agri-SMEs, even in Uganda here, it's going to be very difficult if they are going to grow and be successful just on commercial debt or financing. I challenge any banker, if that is going to work for SMEs that are in the agribusiness space, that are going to grow, prosper, get to be successful in this market with just commercial finance. It's very tough. So we've proven that there are alternatives to financing them. And that's why we go for private equity, venture capital. We've, along the way, lost money. We've also made money. Of course, we make the noises very carefully because some of our investees have been raided when we announce investments or when we announce exits in this region. So I will say at this point, as David mentioned, all protocols observed, everything has been said and done. I will not repeat anything from my predecessor speakers, but I will only say I believe very strongly that if we are going to change things, if we are going to realistically do things differently, then we've got to go back, as the theme says, what can we do as financial institutions? Are there things we can do differently? Are there things we can borrow from our neighbors? Are there things that other economies are doing better? Moses, the former panelist here, pointed out a lot of policy reforms. Are they going to come in good time to rescue some of the businesses that we are seeing in this market, in the agribusiness space? Are some of those reforms or additional capital coming into our space? I know the Capital Markets Authority, my regulator, has only after we've been the only impact fund management business that is licensed by CMA for the last 12 years, and we've only had the second fund management business being licensed 12 years later in this country. When are we having the third one? When are we having other PE funds in this market? When is it going to be a conducive environment? When are we going to do something very different? I believe we are in the PE space, venture capital space, are only complementary to other financing available, like from all the people in this room. There's so much money, but it comes down to how do we structure it, how do we support these businesses, what else comes with it? It's not just the money. What do we do? What kind of BDS services do we provide? What kind of technical assistance, what kind of support do we do as we walk the journey with growing these agri-SMEs? We only focus on the agribusiness space, and what that means, some of the manufacturers in the room have been beneficiaries for our private equity because they are in agriculture. We've done a few transactions. We would be happy to share what we've learned over the years, but it's very interesting that I believe we are complementary to each other with the bankers in the room, and therefore, until we look at them together, it's going to be tough. As I step back from my 3 minutes, which are now all done, I'll share one small thing. Today, this evening, we sign our 14th investment in the Yield Uganda Investment Fund. Very exciting. $1 million of equity. Yesterday evening, I picked the phone to the banker of this business, and I said, look, you are the banker. We are coming in with $1 million of equity. We are funding CapEx growth. What are you going to give us on this journey? When are you ready to join us? And guess what the answer came from the banker? Until the equipment arrives from Turkey and you have installed and launched, you then can come and we talk. Is that the answer I expected? No, because I know once the PE money is in, the balance sheet is restructured, there's going to be equipment, there's going to be a need for working capital. I'm not going to wait for 9 months later, once I'm launching the facility, to look for working capital. Now, is this the bank I'm going to approach, who is the bank of the business? Or am I going to say, come on, dude, let's change and go to a banker that will understand agriculture financing and what you need when you launch the facilities. So I think we are complementary to each other. We need to have an interest into what we do across the various value chains in the agribusiness space, the various manufacturers' needs, as Mr. Muviru mentioned earlier on the previous discussions. Thank you, David.
Thank you so much, Doctor. And a round of applause for Edward. 14 investments is not mean feats. What's the total size of your fund?
We have now committed about 16 million euros to the 14 businesses.
Okay.
And we invest somewhere between $500,000 to $3 million in each of them. And more than half of them have an equity component in it.
Great. I want to stay with you for just 1 second because I think, unlike everyone else on the panel, I know obviously Anthony has FIA, there's a regulatory regime for him. Jordan has the Insurance Act. Obviously, Afrexim is compliant to either one of those. If you had a wish list that we gave to Wilbrod to give to the PS, to take to Cabinet, to give to whoever, is there a policy regime that's conducive for PE in this country that allows you to efficiently deploy this capital specifically for that longer tenure that is biased towards manufacturing?
Good. Thanks, David. I think, yes, this has been a wish list for a few years. Earlier on, Moses touched on this, but I think the taxation policy and framework for private equity funds in this country remains very much lacking. I've said it a few times recently, that when Kenya reduced capital gains tax, for example, from 30% on funds to 5% 4 years ago, they've attracted billions of dollars in terms of private equity funds registering and domiciling in Kenya. And what are they doing? They're able to invest here from Nairobi. So what have they done? They've solved the liquidity problem in Kenya. They've gotten more money in. They've gotten in supportive capital from DFIs and development organizations very easily. The second thing is, I strongly believe if there's anything Wilbrod would worry about is the amount of non-performing loans, especially with what has happened over the last 2 years. What happens? There are so many funds being set up, there are so many youth development funds, there are so many interventions, but are we doing anything about the non-performing loans or turnaround funds or relief funds? How are we structuring them? Are they attractive enough to support the banking space or allow the bankers to worry about what Anthony Kituka just said? How do we evolve, get to support the businesses for growth, while someone else is taking care of some of these turnaround situations?
Great.
Thank you.
Thank you. So we'll take note of the policy aspect around taxation. I think there's a bit more. Flavia, I'd like to co-opt you to take some of these notes as we write to Wilbrod. I'm going to come on to Jonan. Many years ago when I first met Anthony and I was helping him with his maths homework in primary school, he was really a struggler, but we're pleased with the progress. I remember there was this aspect in maths of Venn diagrams where you had one circle and there was another circle and there was that point in the middle where they interfaced. And what has happened recently with bank assurance is that there's banks that are getting into the insurance sector, whether within their own hold cause or in association or affiliation with the members or the rank and file of Jonan's organization. Insurance tends to be sort of the child in the boys' quarters when it comes to finance, yet you have a very tremendous and very important role when it comes to forecasting or pricing future risk. In that context, we all know that there's different tiers of risk when it comes to manufacturing. I think for me, I'd want to ask for your wish list at the end of it all, but can you give us a 2-3 minute take on how your sector is approaching the risk aspect of manufacturing, what opportunities you see therein, or what gaps need to be filled? I yield to you. Thank you.
Thank you so much, Mr. Moderator. First of all, it's humbling to be in the midst of the manufacturers, the likes of the Mr. Mobiros, that contribute 16.5% to GDP, while I contribute below 1%. And yet, much as I contribute below 1%, I play a very critical role of ensuring that as the Mr. Mobiros approach the financiers, the banks, in terms of financing, I then de-risk or offer a solution that will comfort the financiers in terms of ensuring that if things go wrong, if there are uncertainties, they're well taken care of. So as the insurance industry, we definitely see a lot of opportunities within the manufacturing sector. And I think where I come from, and that is the Uganda Insurers Association, one of the things that I see is coming out so clearly from the discussions that we've had here is the aspect of how we can come together and collaborate to then be able to prepare those that come for financing. And I think for me, what is happening lately is that how do we develop the abundance mentality that ensures that we look at each other not as competitors, but partners in delivering value to this very critical segment. And I would want to challenge my colleague Wilbrod that from where we sit as the associations, what is it that we can do to quickly help our members to then be able to offer solutions around preparing those that come for financing? How do we work together to ensure that we can quickly undertake research? And as we undertake research, we are collaborating and identifying all the components that are critical within the value chain. For example, if we're talking risk, if we're talking financing, if we're talking impediments, how do we come together to quickly then assist our members to tick certain boxes very quickly, so that as they go onto the journey of ensuring that they provide the much needed financing, some of the things that would bog them down, we've taken care of them at that level of the associations. I'm thinking that partnerships are key, partnerships are critical, and I know the moderator mentioned the aspect of bank assurance. And indeed, as the insurance industry, we've gone onto the journey to try and innovate in terms of coming up with new channels of distribution, and definitely bank assurance has been an important channel for us. As we speak, bank assurance contributes close to 10% of our gross written premiums. It's an important partner, banks are an important partner. And indeed, we've even gone ahead and gone into the digital space where we try as much as possible to ensure that we are relevant to the manufacturing sector. I know recently you must have heard about the localization of marine insurance, where, like Mr. Mobiru mentioned, they have quite a number of inputs. I think about 70% of the manufacturing inputs come from outside Uganda. These are imports critical for manufacturing. Now, what we have done is to try and ensure that we go beyond giving Mr. Mobiru a policy of insurance to cover his assets that help him in production, but also do a backward linkage and then be able to also ensure that as he brings in his raw materials, we are on hand to ensure that these are covered through an appropriate insurance policy, which on the other hand has been a surcharge if at all there was no insurance. We've also tried as much as possible to go into the MSME space, and I'm glad that MasterCard is here. We realize that more than 70% of the members of the manufacturing fraternity, small and medium enterprises, and we've now partnered with PSFU, funded by MasterCard. We're at the tail end of finalizing this partnership to ensure that we can now craft relevant products for MSMEs, the 70%. I mean, if you look at the clustering within the manufacturing segment, and that is UMA, you realize that 70% of those are SMEs and only 30% are large-scale manufacturers. And yet our products seem to be focused on the 30%. How do we trickle that down and not standardize? We are partnered with Private Sector Foundation, and soon you will see us coming out strongly to ensure that MSMEs now have relevant products that speak to the challenges that they are facing. That would be my take for the time being. Thank you.
Thank you so much. I'm going to stick with you for just another 30 seconds. And again, this is sort of informed by what you've shared. We all know that the offtake or uptake of insurance is not at spectacular numbers compared to countries, say, in the neighborhood. If on the wish list of what we need to take to the PS, we'll take it to Wilbrod, to take to the PS, to take to Cabinet, is there just that one policy adjustment that you think would be a trigger or at least a pivot for you to take those numbers up, particularly within the context of those smaller and medium enterprises that form the bulk of your manufacturing clients?
Okay, thank you. First of all, I would want to say that the uptake of insurance has gone up greatly. Over the last 4 years, I think we've written about more than 4 trillion in gross written premiums. Over the period of COVID and the lockdown, we saw growth in the insurance industry. And I think within the region, East Africa, I think our growth rate for life, we have the highest growth rate as Uganda, over 17%. We have a partnership with government in terms of a private-public partnership where they are helping us to penetrate the agri-sector by offering a subsidy, 5 billion every year. So to be honest, the insurance industry has grown. But if there was just that one thing that I would ask government to assist with, is the issue of walking the talk. I will tell you that we have a number of enabling laws within Uganda, the Workers' Compensation Act of 2000 that mandates all employees to take out a cover, an accident cover for their workers. This has not been followed up in terms of implementation. It's a bit of a challenge, and this would help us in terms of uptake and also the relevance of this product to the manufacturing sector, because if we talk manufacturing, we are talking about work-related accidents. And you find that the bulk of the manufacturers are not taking this product. So if government can help us walk the talk. But also the other thing, in many other countries, government is a huge consumer of insurance. We have not seen that in Uganda in terms of ensuring that government insures its assets. We have seen a lot of damage caused to the Makerere University when there was a fire. We've seen the marine ambulances with engines stolen and then just simply replaced. So government is investing a lot of money in replacing assets as opposed to taking out insurance, which is something that countries like Tanzania are doing very, very well. So walking the talk and ensuring that the laws and policies in place work. And I would want to thank government, just 1 second, because on marine we've walked this journey together, Uganda Revenue Authority, and we are hoping that with the mandatory marine cover and the benefits that accrue to the manufacturing sector and the importers, this should then propel us and help us build capacity so that we can go into the other risky ventures like the export guarantees that the manufacturers are looking for.
Okay.
So thank you.
Thank you. So here's where we are so far. Anthony is saying walk the talk. There is policy, maybe some adjustments. Yonan is saying the same thing. Help us as government to grow the industry by off-taking our products. But Edward is talking to the bankers and saying, when I have de-risked a business, can you come and complement my funding? And I think that's effectively the conversation about complementary actors in that space that is necessary to progress. And I guess some of the insurers need to come and speak with the private equity fraternity about pricing the risk around their capital, their operations. And this is specific to that informal sector that we speak with that forms the bulk of our productive economy. So that's really the WhatsApp group. I'm going to bring in Richard, who I'll appoint the admin of this group, because you have a very sort of continental perspective. You have businesses that or business units that speak to every component of what I have on the panel, and obviously on the topic of our conference and our panel itself. But before I do that, I'd like to welcome you first to Uganda and welcome you to the Fraternity of Uganda Bankers Association. I believe they are fully subscribed. Did the check clear? Rich, Wilbert, the money's in the back. Great. Karibu. I'm going to spare you an interrogation around policy and sort of use your presence here and perspective to sort of reflect on what you've heard and bring to bear, of course, you have a specific trade, import and export mandate, and when we talk value chain, it extends to some of the conversations here, but actors who are not in the room, you have interventions around TA, etc. I won't really dive too much into the aspects of my research, but from this conversation over the next 3 to 5 minutes, how does Afrexim Bank come into play to deepen that value chain that we're speaking about? What is your perspective? Over to you.
Thanks a lot, and good afternoon, everyone. I know I'm standing in between you and lunch, so I'll try and be as brief as I can. So in terms of numbers and what we are speaking about, so the African Export-Import Bank, or the Afrexim Bank, is a $22 billion asset balance sheet Pan-African institution. Our shareholder funding is in the region of $4 billion or thereabouts, and our asset portfolio or loans is just above $18 billion. Now, these funds are deployed all over Africa. The bank is owned by the member states within Africa, currently about 53 or 54 African countries, and we can do business in those countries, about 52 of the 55 African countries. Our role today, and especially given the conversation we are having today on catalyzing and improving manufacturing within Africa, is, I would say, complementary to what the commercial banks are doing, complementary to what the private equity financiers are doing, and much more so also complementary to what the insurances will do to us, and especially to enhance the structuring. I will curate these around three themes, and the first one is if we look at the bottom of the pyramid, and we've been told it's about 70% SMEs or MSMEs that contribute to the manufacturing space within Uganda. I want to believe there should be a way we define that so that we are clear, or there is clarity, who do we define as an SME, and who do we define as an MSME, and then who do we define as a corporate and then a large corporate. And I say this because the role of a DFI is to complement what the commercial banks are doing. We may not, at the end of the day, given our limited geographical exposure, be able to reach the breadth of all the SMEs. And how we define SMEs as a Afrexim Bank, or as most of the DFIs, is could also be defined as probably a large corporate to a commercial bank operating here in Uganda. So we'll need that clarity in order to make sure that we are channeling the funds or structuring the financing in the right direction. That's one. Then secondly is to utilize the available resources, especially within the financing space. A family-owned business may not necessarily want to let go of the business, but they could be willing to take a perceived higher risk and therefore invite private equity players, and they move into the next level. If they are looking towards export and they have reached a certain threshold that the local commercial banks are not able to fund them or meet their needs, then the DFIs will come and play that role in three ways. One is offering hard currency financing, either in dollar or euro. Secondly is offering longer tenors. And thirdly is taking higher than average risk. You know, the commercial banks are regulated, so they may not be able to go beyond a certain obligor limit. Afrexim Bank is self-regulated, so and given our balance sheet size, then we are able to do much more. On the hard currency financing, most of the markets where we operate in have a hard currency challenge, and that's where we come in again and offer that solution, either in dollars or euros and in adequate volumes. I'm very cautious about adequate volumes. And then thirdly is about taking higher than average risks. So we are able, as DFIs, not just Afrexim Bank, but most of the DFIs, we are able to do greenfield financing because that's our mandate, to catalyze infrastructure within our member states. And this infrastructure could include greenfield type transactions. Could be in, as the earlier panelists talked about, enhancing the resources within a certain country, limestone, iron ore, and the like. And we are happy to partner with various entities to catalyze that trade. I'll give two more examples on what we are doing, especially within this region. in the neighboring country, that's in Tanzania, through our Pan-African focus, we were able to partner with 2 leading African contractors, El-Swedi and Arab contractors, to help them win the bid for the bringing on stream of the Rufiji Dam hydropower electric. How did we do this? We were able to grant them a guarantee in the region of just under $1 billion. And out of that, they were able to win the bid to bring on stream the Rufiji Dam. If we did not do that as a Afrexim Bank, most likely that bid would have been won by a contractor outside Africa. But because of our role of catalyzing the intra-African trade, we were able to offer that solution. The second example I would give is what we are doing on, again, enhancing intra-African trade, especially as relates to movement of goods and services, so on the logistics side. We do offer transit guarantees. In other words, if you're importing your goods from the Mombasa port or the Dar es Salaam port and taking them down to South Sudan, you will need a transit guarantee. You will need a bond on the Kenya side. You will need a bond on the Ugandan side. You will need a bond on the South Sudan side. And the 3 countries most likely have different regulatory regime. Given our Pan-African status and the concessions and the privileges that the African member states have granted us, we are able to issue you with 1 transit guarantee, making it seamless for you to transport your goods from Mombasa to Juba with 1 bond. And this is happening within this side of the world. So what I submit to us as bankers is to be responsive to the needs of the day, to have clarity on what the manufacturers, the farmers, the agro-processors need, and curating interventions that would help address that. And lastly, I think it's also important that we take cognizance of the need of the human resource capacity and capability by improving efficiency and productivity of the people. And for that reason, Afrexim Bank is putting up what we call medical centers of excellence all over Africa to help and enhance the health and well-being of the people, so that we can again curb what we call medical tourism and be able to reflect back and have the dollars be retained back in Africa. Thank you.
Thank you so much, Richard, for that most useful submission. And I suspect Yonan would be interested to know whether within this trade guarantee facility, I don't know whether it's partial or full, whether you'd co-opt local insurance companies to participate in sort of the premiums around that. Is that something that you'd consider?
So we are taking a multifaceted approach. Through the COMESA Secretariat, we're able to issue that 1 transit guarantee scheme. But then it has various components when you're getting in various countries. So if it's in Kenya, you have to, we as Afrexim banks are the ones now speaking directly with the regulator in Kenya. In Uganda, it doesn't have to, yeah.
Okay. Yeah. And we note that
you can use this.
We note that Afrexim Bank has an office in country. I think it's the 1 regional office we have in East Africa, so we appreciate your presence here. There's recourse, Yonan, to Afrexim officials here. So here's where we are, and help me, audience, here's where we are. Anthony wants action, call to arms, there's enough policy. Edward wants Anthony's money when he's going for the second fund or when he has de-risked the project. Jordan, from the insurance perspective, does not have a problem with policy. He just needs more premiums to be coming from government and other actors. And what we have found from the submission from Afrexim is that they seem to have a solution that allows Edward to have some bridge finance before Anthony is convinced to give him funding, and also there's a co-option of potential business from the insurance space. I think in as far as manufacturing is concerned, my panel has sufficient capacity and intent to execute and sort of put that number up. I'm very proud of the first round of discussions. What we do have right now, however, is a conversation around sort of the rope you need to give Africa as we move from agrarian to light or heavy industrialization, around the green policies that are being sort of impressed upon us. There's the expectations around what the consumer wants around their project, their products that they consume. So the shade of green that we are experiencing right now is quite deep. I think it's enshrined in laws, in multi jurisdiction protocols. It's something that we can't go away. So I want to go back, first starting with Edward, because by principle, I think PCP has from the get-go had a sustainability component enshrined in it. Is it something that from the manufacturing side you're very emphatic upon when you're perhaps appraising the potential of an investee? How's that dimension around green compliance coming into the funding that you're presenting to these manufacturers? I'll give you a minute and a half for this.
Yeah, thanks, David. I think, yes, we know in today's times, climate, all these things about ESG, all things about health and safety have become very critical. And now it's even going as far as being very sensitive about things like gender balance. If you have investees, people on their boards, you have to be careful whether you are ticking all those boxes. Because many of the development partners, many of the capital out there, many of the people investing alongside us or even giving us the capital to invest value these things. Do the entrepreneurs, do the farmers in Uganda, deep down in Kavera Maido, the farmers in the villages, do they care about some of these things? I think it's a process of educating them. Some of the investees we have invested in, we embed the ESG requirements as part of our investment thesis. What that then means, we're able to support the SMEs, factor this as part of their growth strategy and plans and things to work on. Even when we go for due diligence, for example, we have ESG experts that come in, not to blame them, because people are working in a factory without masks or health and safety requirements, but agree with them on how do we get there? How do we walk the journey with them? And in some cases, I'll tell you, for example, over the last 2 years, during the pandemic situation, our BDS support, our grant support from the EU to support our investees was able to shift as one of the interventions from a contribution of 50% to the ESG interventions or smallholder farmer interventions to 85% contribution. Why did we do that? Because we felt the SMEs needed the much needed liquidity to try and run their businesses, have the sufficient working capital preserved, but then while at the same time we needed to motivate them and support them deal with the much needed ESG interventions that we've identified at the point of making those investments. So yes, it's very key and we value it, David, and we tend to walk with them along the journey. One thing I'll say last is the fact that many of the SMEs in the agribusiness space, in the manufacturing space, will worry, first of all, about the survival of their businesses. Will worry about how are they going to source supplies or raw materials. Will worry about the growth of their businesses before they worry about ESG, before they worry about the climate, before they worry about some of these things. But that's practically, in practice, real in Uganda. I've seen other people who say, oh no, Ugandans are very, very, very careful about the environment. They will prioritize climate change, or they will. No, it's not. It's the SME businesses first. It's then the next thing is how do we work with various sectors and interventions to support some of these things. Thanks.
Thank you. And I guess I'll latch on to climate change and segue into the insurance subsector or industry. I guess I think the statistics around Uganda is that, like, if you rank the countries in terms of climate change vulnerability, we're about 12th most vulnerable. We're very agrarian in terms of our product. We live off the land, and some of these changes that are being felt are feeding into our yields, crop yields, and I think it will affect every other aspect of the value chain and eventually the pricing of finance, I suspect. From an insurance perspective, is that having an impact on how you would approach policies or premiums or the pricing of insurance? Is climate change something that is affecting you, and how would green insurance look like when we take the conversations to the manufacturers?
Okay, thank you so much. Now, I must confess that matters of ESG are new to the insurance space, in all honesty, because not until we then ventured into the oil and gas space that we felt the impact, the real impact of ESG. Previously, the thinking was, I mean, you have your asset, I will cover it, be able to ensure that when there's a claim, I can be able to settle it. But we have seen a shift in terms of how we now respond and relate with the ESG matters. I will tell you that two things have happened. One of those is what I've mentioned around the oil and gas space, where we took our capacity together as the insurance industry, but because of investments, and that's my second point, because of the investments by the strategic investors within the insurance space, we have seen our capacity dwindle because of ESG matters. So what we can be able to retain in terms of the oil and gas space has been greatly impacted by the aspect of ESG. But the challenge, like I mentioned, is that we are in a bit of a controlled sector. We follow laws and we have to comply. One of the complicated issues is around our rating. Our rating is controlled. We are under minimum rate guidelines where we don't go below a certain threshold. And we are now having a conversation to say, how do we reward businesses that are putting ESG at the forefront of their operations? We've gone back to the drawing board to see how best that can now be incorporated within our underwriting to ensure that these good practices are encouraged, not only by our clients taking them on, but also for us as insurers. And for me, what I see in this space that we are in, especially manufacturing and even mining, which feeds into manufacturing, is how do we create that safe environment where we can be able to undertake some of these fundamental investments that are crucial to our recovery, crucial to our growth, but do them in a controlled way, in such a way that we can balance the fears that the ESG and environmentalists have. I think that is where our focus should be, because we can't say that we will not manufacture. We've all seen since morning the advantages that manufacturing is going to bring to this economy if we take it seriously. But there are also effects on the environment through manufacturing. How do we do it in a way that it's controlled? How do we go into mining? How do we go into the space of oil and gas in such a way that we comfort the environmentalists that as we go into exploration, as we go into production, we are doing it safely? And I think for me that is where the discussion should be.
Thank you so much.
Thank you.
And that kind of speaks to what was brought up in the panel before around the preference for some of the commercial banks to skew towards treasury bills for that premium, which from a risk perspective, risk being the operative word, is not as heavy as it would be for some of the constituents in the manufacturing space. I think the insurance aspect of it all, understanding what changes and pricing that, is something that would really give the bankers an incentive to progress. We're going to wrap up with Anthony and then with Richard, and then we'll open the discussion to the floor. I think we're doing well for time, Flavia, are we? It's about an hour now. Are we good? Okay. So value chain. Value chain means that on occasion, the bankers that you employ need to go and spend time with the farmers, understand the dynamics of their business, and it does not stop there. After there is a product, the conversation also extends into how you help them getting it to a market, be it domestically and regionally. Anthony, is there something within that dynamic that you feel requires a little bit more emphasis? Are you doing more than you should as a banker? Or is there more, is there space for other actors to complement, specifically, again, going back to the fact that our value chain is not terribly sophisticated, but there are very important constituencies in the manufacturing sector. I'll have you apply your mind on that.
Again, thank you, David, and thank you for remembering me. Just one correction. That homework I copied from you, it was wrong and we all failed. Value chain. I think, let me just talk about banking, and commercial banking has to change. It has to change with the times. And we are known to adopt some things either as fads or as necessity. Brett King one time said, in the future we'll need banking, we won't need banks. We will need banking, we won't need banks. He was just pointing out that banks don't seem to be sometimes daily relevant. They're not relevant to the needs of the society, of the communities, and so on. And some organizations, some banks have been changing that narrative, making sure that you have a social impact and a commercial impact. What is the value in capacitating a value chain if you can support the households which will consume the output of that value chain? If you can't link markets which will be able to offtake, if you can't link other stakeholders who will benefit from this new capacity. Because you increase capacity in one area, create a bottleneck in another. And you have to just keep solving those until you get, in my mind, from plant to plate for agribusiness, from raw material extractive to consumption. So banks have to start thinking about that in their thinking about value chain. Secondly, at least we believe at Equity that we are not the experts. So we are very happy, for example, in agriculture, to say, I'm a banker. I know how to assess risk. I know how to lend money and make money off that. But in agriculture, I don't know. So what Equity does, for example, we hire agronomists and teach them banking, as opposed to teaching bankers how to become agronomists. Same approach with extractives, same approach with manufacturing. We partner with the people who can do it. And that is the thing I think that Jonan mentioned, partnerships. I also think the PS mentioned as well, partnerships. Banks have to understand. That's why when Edward didn't come to my bank, if he had, I'd have approved that one straight away. Because for us, we clearly see a link. I'm not concerned too much about, okay, I'm happy to make sure the manufacturer can produce as much as possible optimally. And we have products for that. But how do I ensure that the MSME who is going to either supply raw materials or input, or he's going to help distribute and sell and reach the end consumer, how is he plugged into this process? And how does, as the bank, how do I de-risk that? Some elements I can de-risk using products, using insurance. Others I can get risk participation with my friends from Afrexim and other DFIs or DGIs. I can find partners like MasterCard and have them come in and play a role either in technical assistance, in providing digital solutions, to try and make this process as easy and cost-efficient as possible. Ultimately, I want to believe in the result. I want to be sure that as we're linking all these people, the manufacturers are empowered. I think Richard talked about segmentation, corporates, small or large corporates, small, medium enterprises, down to micro, down to consumer. Everybody in those segments. And the base, of course, becomes wider as you get to the bottom. And the fact is, banks now, as well as telcos, are your best distribution model for solutions, whatever it is, because of reach, because of access, because of ease. And how do banks become, let's say what, more impactful in that? In our organization, we believe if we do good, we will do well. So we get our license to operate in community from the society. That's my social license. My commercial license comes from my regulator, the central bank. And how do we bring all and blend all those together? How do we bring more partners into this? I think we bring in partners at all levels, regional level, global level, financiers. How do you bring in like-minded people to get this done? The key thing ultimately is, what's that big number? Is it is it middle income status? Is it better food, better social services? How do you partner with the government in executing this, using the tools that you have within your environment as regulated? Or can you be creative? Can you find other ways? And now, for example, coming back to things like ESG, governance is an issue in banking, from the banking side, yes, and even from the business side. Most of the businesses are family businesses. They begin that way anyway. And Edward talked about, do you want to let anybody in? How do you survive 5, 6, 8 generations? Why does it work so well in Asian countries and struggles in Africa? And our exposure to all these businesses gives us a ground to provide advice, just beyond the loan and the working capital line. So all those things have to be thought about when thinking, was Brett King right? We'll need banking, we would need banks. Banks have to become more relevant, socially, economically. They have to address more constituents, consumers, businesses, and communities. And we must support anybody who's trying to help Uganda, East Africa, Africa, recover and become more resilient. And so finding those gaps isn't the issue. It is executing our mandates with a clear focus on that element, that we must punch both socially and economically. Then we'll be relevant. Thank you.
Okay. I think Anthony spoke about doing well and doing good. There are multiple slogans around sustainability. I just checked on MasterCards. It's always moving forward. I don't know what Africisms is, but I think the general thrust around sustainability is a given. And I'm going to come back before I hand over to Richard to have his closing remarks. He's a sponsor, he's new in town, so allow my bias a little bit. The National Development Plan does speak about sustainable industrialization for wealth creation. So it's enshrined in the policy document that is guiding this phase of our development journey. We can't shy away from it. But just to go back to the beginning, I said manufacturing is a huge, huge part of that. We're one of the 18 pillars. And it is something that's going to effectively help us transform. PDM has been embedded in some of these policy actions. Do we have manufacturing as a receptor to it? Richard, my question to you really is, you're new in town. You've observed the discussions on the panel and some of the keynotes that were submitted earlier. In your sort of 1-minute wrap-up before we open the floor, what is your take on, do you leave this panel with a sense of optimism? Do you see some gaps that Afrixim can address? As my co-admin of this WhatsApp group, how do you see us taking these discussions forward and tapping into some of those solutions that you have? Over to you.
Thank you. Thank you, David. And yes, there's a lot of hope, not just in Uganda, but in East Africa and Africa generally. We must have hope and faith for a better tomorrow, and we have to work hard for it. Again, I'll give 2 or 3 examples. in order for us to catalyze industrialization and export development in Africa, and therefore enhance intra and extra-African trade, we realize that there is need for export manufacturing. But whenever you're exporting your goods out of Africa, there will always be the question about quality. How would somebody outside of the borders of your country believe that the product you're producing is to the best quality, is international best practice standard? And having realized that, Afreximbank is putting up what we call Africa Quality Assurance Centers, the first of which is being put up in West Africa, the second is going to be put up in Ethiopia, and the third one is going to be put in Tanzania. Why we are doing this is because we want to enhance the quality of the goods that are coming out of Africa and make the world believe that Africa can produce as good and as better as any other part of the world. That's one example. The second one is in relation to what we bankers call, we will finance bankable projects, not ideas. And so there's always that need to move away from ideas into concepts and then into bankable projects. But then how do you assist that large corporate or that SME move away from idea into concept into bankability, so that either the local commercial banks will be able to do that, or the private equity players will be able to finance them, or the microfinance institutions will be able to finance them? When it comes to the large projects where we do have a role to play, we have what we call project preparation facility. It's a facility of up to $2 million available for entrepreneurs who want to move their projects out of concepts into bankability. And we walk and journey with you to make the project bankable. And then we crowd in other financiers. It could be the private equity players. It could be the commercial bankers within the jurisdiction where you're operating in. And ultimately, if the project does require, and more often than not, it will require credit enhancements, then we'll go for insurance from the local market or enhance it with reinsurance from elsewhere. So that's the second. Then third and lastly, on the item of ESG, environmental, social, and governance, this is within the DNA of every DFI. We will not come and finance a transaction if there is no additionality. Triple bottom line: people, purpose, profit, always. It's in our DNA. The facility agreements we will sign with the entrepreneurs will have an obligation to them as covenants to adhere to certain environmental and social and governance requirements. And why we do this is because we believe in a better tomorrow. We want to make Africa great. We want to make sure that whatever is happening here in Africa is at par with the rest of the world. Thank you.
Thank you so much. And I'll just quickly draw a line between our panel and Paul's panel, where the, I think the ED of the Manufacturers Association was talking about sort of the construct of capital, and I think that project preparation facility would speak well to some of those challenges that they have. I see Uganda Development Bank is represented here. They have their own facility that may complement yours. So in terms of calls to action, I did start as an intermediary in my business. I'm trying to get these things going forward, and I'll hold it upon ourselves to make sure that we progress on these commitments. It's time for me to open the floor. I will borrow from Paul's model and ask for 3 to 4 questions, which we will circulate. And I think some of these conversations need to progress thereafter. So we will, through the Bankers Association, figure out a way of onboarding some critical comments that we can't really accommodate within the time remaining. So yeah, over to you. Thank you. Question here. We need gender parity in the questions as well. Please introduce yourself, keep it concise, and mention who you want to address the comment or question to. Thank you.
Thank you very much. My name is Jemba Kanakulia Mlondo. I'm standing in for the chairman, Kasita Uganda. Protocols observed. I would like to thank the organizers of this conference. However, I can see one missing component when I read about the theme, bridging financing gaps in manufacturing, tourism, and agribusiness. We are missing the component of trade financing, which is a critical area and an intermediary when we talk about all the three above. I would like to see a conference like this happening again with the trade financing part of it. Otherwise, immediately after COVID lockdown, most economies were focusing on trade financing as one of the key critical areas which needs to be addressed if we are to see or if we are to recover ably from the effects of COVID. Then the second one is about the insurance. My brother from insurance. We appreciate your role and understand where you are coming from. But we haven't seen much being done, especially as far as ESC and the African Continental Free Trade Area is concerned. We'd like to see you playing a more active role as we focus on African Continental Free Trade Area. Thank you very much.
Thank you. My name is Jamil Ndiang from Tropical Bank. I'm here on behalf of ED. Thank you so much, panelists. My submission will be on a very important area on my side, the Islamic financing of banking. I see quite a number of opportunities that are associated with Islamic finance, which all of us bankers can think of. A number of investors would want to come to the country to invest, especially from Middle East, as long as we have Islamic banking on board. Well, it's there under microfinance, but as far as commercial banking is concerned, we are still behind. The government has been struggling to bring this on board since 2016. The Act came into law, the regulation in 2018. Then Ministry of Finance informed us in 2021 that they are implementing it. But up to now, we are wondering what could be happening, and there is potential. We are all bankers, and I believe you have very many customers who do benefit from this, especially on the Muslim side. Well, it's not for only Muslims, but I want to urge all of us to think about this, or to pass over my message to the government and Bank of Uganda as well. We have very many clients, or a segment that is left, that would want to embrace that. Thank you so much.
Thank you, David. On the 10th of June 2015, the then Minister of Trade, Industry and Cooperatives signed on behalf of the government of Uganda the COMESA, ESC and SADC free trade agreement I think it was in Egypt, And this came into force to enable all these over 650 million people of trade. Now, to what extent, Richard, has Uganda in particular, and EAC in general, benefited from this? To what extent have our own, those who are manufacturing, adding value, having value addition, to what extent are they benefiting from this? In the year 2000, there was a summit here in Uganda. I think it was called the Smart Summit, where the Pan-African Trade Insurance Agency was born, ATI, the African Trade Insurance Agency, which is underwriting a number of investments, businesses for Africa. It is at a Pan-African level. To what extent is Uganda benefiting from this? I have seen a number of people from Kenya have benefited. How come our own here, the traders, the manufacturers, they are not benefiting? Thank you, Chair.
Thank you. And as we pass on the microphone to the last two questions there's a lady and a gentleman there. For those who don't know, Honorable March was Minister of State for Finance, so I'm sure he was in the room and very critical in those negotiations. We thank you for your service. And he also worked in a commercial bank, so he has that experience. So we need to leverage people like this who have allocated their time for this. Asante-san. Next question.
Thank you very much, moderator and the panelists. I'm called Okecho Lawrence Michael from Uganda Export Promotion Board. In government, we have under Uganda Investment Authority the bankable projects. And this is something that when we were in the Dubai Expo, we were actually selling to the world. I don't know how far the commercial banks in Uganda have taken interest in looking at these bankable projects. But in addition to that, from government, you know, we come up with the bankable projects. I don't know whether commercial banks also have that arm of looking at bankable projects, because we have people in this country who say, I have my money, or we have our money, what can we do? And I think the banks, there's that window where the banks actually need to begin looking at this. Much as the bankable projects from governments may be very big, but I think it is still an area that we need to look at. Secondly, we want to improve intra-Africa trade. And the banking sector is very key in this. Now, from the presentation that was made by Uma, you realize that most of them are actually in secondary manufacturing. And if I made an estimate, I would be saying about close to 95, if not 97% of the manufacturing sector in Uganda is in the secondary manufacturing. But you realize that primary manufacturing is very, very important and key for us to achieve our intra-African trade targets. When I say primary manufacturing, what I mean is manufacturing establishments whose outputs are actually inputs into other manufacturing establishments. And that is very key for Africa. So I don't know to what extent the banking sector has interest in this. The other thing is the issue of pooling resources. And this still takes us back to the issue of saying there are people who say they have their money and this money sits in the banks. They don't know what to do. They're looking for things to do. I think the banks have a role of identifying these fellas, and as they develop bankable projects, the way government does, they should be able to pull these people together and say, well, there's this project that you people, if you teamed up, you'd be able to run with. Thank you very much.
Thank you. And finally.
Thank you. My name is Doreen Lukandwa from MFS Africa, MFS Africa is the largest B2B digital payments hub, connecting over 34 countries across the continent. My question is to the two bankers on the panel. One of the biggest challenges facing or hitting e-commerce is the cost of settlement and FX. I'm curious to hear how you envision democratizing that. Thanks.
Thank you. That's how questions should be asked. Shall we start with Casita to Jonan? Then we'll segue to Richard from Honorable March, and then the last question. Should start with Richard, please.
Okay.
Thank you.
Thank you, Mr. Jemba, for your question. I hope I'm audible enough. I think your worry is that we are not participating at the level of the East African community and also the Africa Continental Free Trade Area. I think, Mr. Jemba, that comes as a result of the nature of the business that we run, and also the nature of regulations that we follow, and the compliance aspects. I will tell you that at the East African community level, we are participating, and I think we're talking about the customs bond, where we have been in talks with our colleagues at the regional level to ensure that we remove the duplication in terms of the customs bond that would be required in all these markets. But I'll also tell you that the initiative that we are running under marine insurance is also as a result of the East African community and also as a result of ISCOS, which is the Intergovernmental Standing Committee on Shipping. Now, a research was conducted which then showed the revenues in terms of taxes and also premiums that were being externalized due to the fact that importers were buying insurance offshore. I think these are initiatives that have come out of this arrangement of the East African Community. And we continue to engage. Insurance is a specialized area where we also work within jurisdictions. So we have got then to ensure that our laws speak to each other at the level of the East African Community, and where we can, we continuously engage. But I will quickly also would want to submit on the Honorable's question around the ATI and also the issue of Islamic banking, which also has a component of Takaful, which is Islamic insurance. 1 minute I've been given. ATI participates on specialized risks. For avoidance of duplication, the local market will handle the risks within, but there are those specialized risks that then will go into the specialty markets through windows of vehicles like ATI. I'll tell you that the export guarantee scheme or insurance that the manufacturers want is available at the level of ATI and other specialized markets, but can be written on a fronting basis using a primary underwriter who is then an insurer here. The biggest challenge is on the requirements and the criteria. That at times our people may not be able to meet the criteria that is required of these vehicles. And I think that is where the emphasis should be in terms of how can we then be able to ensure that as these products are being sought after, we can demystify and ensure that they speak to our local requirements. On Takaful, we are now at the tail end of regulations in terms of Islamic insurance. These regulations have been crafted and they're being finalized. On our side as insurers, we will be ready to take on Islamic insurance.
Thanks. There are three questions. One is on how has Uganda benefited on the various treaties that it has signed in with EAC, SADC, COMESA. I think from where we sit as a Afrexim Bank, we support the regional institutions to trickle down to the local markets and enhance what we call either policy or legislative action that would enhance or help the country get through to those benefits. For example, we will be putting up the Africa Trade Center here in Uganda as a Afrexim Bank as part of our efforts to enhance trade within East Africa, within the business community. One of the key benefits of that which we are looking to enhance here is what we call twining. In other words, what is best practice happening in West Africa that can be replicated in East Africa? Is there a very good supplier, for example, I don't know, Dangote Cement based out of Nigeria, wanting to come and partner with somebody here and help exploit the limestone to cement and then become a big player elsewhere. So that's one of the things. But moving it a notch higher, and especially learning from what happened during COVID, one of the things that we did as a Afrexim Bank is establish the AMSP, the Africa Medical Supplies Platform, which enabled Afrexim Bank guarantee the purchase of 2 billion worth of doses for COVID-19. This would not have been possible if Afrexim Bank was not there, first of all, to guarantee the supply and then enhancing the supply through that AMSP, of which Uganda benefited again. So there are several linkages that we can look into, but then the policy and the legislative action has to follow suit. On the question of Islamic financing, I just confirmed that ISDB, Islamic Development Bank, is already here in the market. So from a DFI angle, that's possible. I know from my previous life, I was able to do some Islamic financing, more specifically actually as intermediated financing to a local commercial bank through my previous DFI employer. And then lastly, on the issue of e-commerce, yes. So to the bankers, because of the role of financial intermediary that you play and the trust that your depositors are placing on you, then the two items become very important. One is KYC and secondly is distribution. So on the KYC, we realized that from a bird's eye view, when you look at Africa, Kenya has a different legislative regime on KYC. Uganda has a different one. Tanzania, you go Nigeria, South Africa, wherever. So what we did as a Afrexim Bank, and given the Pan-African mandate that we have, is to create a KYC platform that we are enhancing through the AFCFTA framework, enhancing a common platform or a common ground for all players within the financial sector that they can, link into. More like what you have as WorldCheck to bankers. So we have such a platform that is being enrolled. And then on the e-commerce side specifically, we have what we call a payment PAPS, payment application system. Again, being rolled out throughout Africa, more like what you have as SWIFT. So Afrexim Bank is creating a SWIFT for Africa. That's the best way I can do. And what that is going to do is a small country, quote unquote small country, however you define it, be it on geopolitical size or GDP, compare Burundi and Kenya, PAPS will be available to Burundi as it will be available to Kenya, thus democratizing that payment application in Africa. Thanks.
Okay. I think my colleagues have answered most of the questions. I think, let me just touch on trade finance. Yes, Mr. Jemba, yes, I agree entirely. Trade finance helps identify markets, helps transfer capital goods in, helps send manufactured products out. And that's a good part of our linkage. So yes, I think it should be something we should be very keen on. Of course, it depends on your export markets, it depends on quality, it depends on rules of international trade, it depends on logistics globally, and all those different things have to be coordinated. But it is a key part in ensuring manufacturing does make sense from a business and viability perspective. So we apologize for that oversight. I'm sure our Wilbur has taken note. We will definitely have a touch on trade finance. Roy from UIA. Question on bankable projects from the government. Yes, I mean, most banks do have a public sector unit or department which engages primarily with the government and MDAs, trying to see which projects are being financed, because the biggest spender is the government. So definitely some of those projects are a bit long-term in nature. I mean, certain energy projects, certain infrastructure projects, And I think there are different financing mechanisms for that. But of course, banks come in to facilitate with some of the working capital lines. They'll support the contractors as much as possible, with or without collateral. The contracts sometimes are good enough, invoice financing, LC financing. There are different mechanisms to support that. So we may not take the whole government project, but we'll take small chunks and see how to play there as commercial banks. Of course, my colleagues in the DFIs are big financiers of these projects. You asked about intra-Africa trade, and it's a big part of what some organizations like Equity do. I mean, I think the PS mentioned earlier this morning, our presence is in Kenya, Uganda, Rwanda, Tanzania, South Sudan, DRC, and Ethiopia rep office. That is a whole trading block. We keep saying we have connected the Indian Ocean to the Atlantic. And I think the PS mentioned cross-border trade, increased cross-border trade, talk about activity at various border points, and that just enhances the ability for you to find additional market, either for your goods or for your raw materials for your own processing. So I think a bank which is available in all those regions will help. It will be the glue. If you're in one banking system, buy raw materials in Uganda, in Nairobi, manufacture in Uganda, sell in DRC, and get paid. And seamlessly, that is what should happen ideally, and I think banks are trying to do that. Lastly, I think, Mr. Roy, you mentioned something about pooling resources. I think banking by its nature is about intermediation. Intermediation is we get all the money from people who have excess and find those in need and put those together. You'd be surprised, but the rule of thumb is that only about 10% of your customers are borrowing customers. The rest are looking for a safe, secure place to put their money. And that's in different levels. So the thing about intermediation, I agree with you. At a higher level, obviously, the wealth management will allow you to pool resources and identify investment opportunities. And some banks do have investment units which help find these places to provide investment. And you can partner with my friend Edward over there. And those are the, and again, depends on your interest. It could be agri, it could be education, it could be health, it could be tourism. You want to put up a hotel and you have excess funds and the wealth management, there'll be a product under the bank partnering with another equity player, and you're in. To the lovely lady from MFS, your question about settlement of FX, democratizing e-commerce. I think as my colleague from Afrexim has mentioned, there are certain institutional challenges in FX management, settlement. We are regulated, we have to worry about things like anti-money laundering, countering financing of tourism. Those are just our rules. But there are other underground things. National IDs, there's a money go to the right person, KYC. That's just the way we're regulated. But that doesn't mean there's no opportunity. It just means that you have to partner with the right people and get the right support and structure, the right technical tools. We're working with the government, obviously. I mean, at a very basic micro level, for example, Equity has got *247#. Open an account on a phone, *247#, ends up in an account. That's because we have linked to NIRA, therefore we've done the KYC. That means any money coming from anywhere, from any of the partners, national money partners, including MasterCard, will land in somebody's account in the village in Rushere. So the question becomes, how does some people actually are doing e-commerce of sorts using mobile companies?
I think, if I may, Anthony, I mean that product that you have in partnership with MasterCard is well documented, and it's something that we can unpack as we progress.
Yeah.
I feel like some arrows will be coming in my direction if I don't wrap up now. But 2 points. I think one, on the matter of trade, the chair of Uganda Bankers Association talked about a credit facility. I think it's ₦1 trillion worth of export credit that's being packaged. Wilbert, nod your head. And then two, Anthony and I have joked about homework, but we have homework to do. And if I may just list Section A, Section B. Which one is harder, A or B?
B.
B. So let's start with Section A. There's insurance that is a service that we want to put towards the public sector. That's an action point that we need to take through to the Insurance Association. I think there's a conversation between Edward and Anthony on the aspect of making sure that whoever is going through the pipeline of PE can be met with a complement of funding. There is conversations about Sharia, etc. But I think the bow that packages our panel up is the helicopter view that Afreximbank has. I would like for him and his office to commit to spreading the gospel of your project development funds. We have the Export Promotion Board here. We have UIA, my big sister Winnie Laoko is here. She's talking about SMEs and how to get that industrial park story progressing. And then I think that suffices in terms of our first conversation. Wilbrod, with your permission, I would like for my panel not to collapse here. We'll be knocking on yours and Patricia's door to give you a report card of this homework. So allow me, ladies and gentlemen, to give a vote of thanks for my panel. Please give them a round of applause. They've been most distinguished and informative, and I beg Flavia to end it here. Shukran.
Thank you so much. Thank you so much to the panelists as they walk off the stage. I'd like for us, I know we can smell the goodness a few minutes away, but I think it is very important, as one of our sponsors who's been with us even before and who also champions a couple of conversations. You saw the video that data is very important in these conversations as well. Please welcome the General Manager for Raxio, James Byarahanga. Even with the hunger, welcome him.
Hi. Good afternoon, everyone. Flavia, they usually say that the hungry Munyankole is called Byarahanga. Very cheeky on your side. I know it's lunchtime. This is not a great time to talk to anyone. People are not so focused. And I will try and make it brief so that you don't get caught in this. My name is James Byarahanga. I'm the General Manager for Raxio Data Center in Uganda. And we are basically a tier 3 data center. Uganda is the first country that we launched. It's one of several that we're building. We have a roadmap of about 10 data centers in Africa. As I mentioned, Uganda is the first one. Ethiopia will be the next one. We have, so we have DRC and Ethiopia currently under construction. Côte d'Ivoire also under construction. Maputo been announced, and we have Angola as one of the next ones. But basically, we have a rollout plan of about 10 data centers in Africa. Data centers in general are environments or buildings where you can bring your equipment and we can provide, fire suppression, the right temperature, connectivity options, floor space, good power, reliable environment that you can actually use for powering up your equipment. The theme this year is focused around tourism and manufacturing. We all know that manufacturing right now is driven heavily by IT. Banking sector is driven by IT, and we're basically providing an environment for disaster recovery and business continuity. A lot of my customers are in this building. A lot of the customers that I'm in discussion with for migration are in this building, and some of the customers that we're in early stages with in this building. In Uganda, we are actually located in Namave Industry Park. We've built a 1.5 megawatt facility, 400 racks capacity. We're in early stages of our second site, which we are thinking about a location in the general area of Kawanda. Data centers depend on power a lot, so we need really stable power, and Kawanda is one of those locations. The idea about that is to give you a disaster recovery location as well for our primary site, and we're also in early stages of Raxio UG3, which we're looking to build in the oil and gas area in Hoima, near Kawala Industrial Park. We provide uptime of 99.9% so that your equipment doesn't go down. We've never actually had an outage from the day we open for business, yeah? We provide simple services, and I don't want to go into too much detail because we've got an exhibition booth outside, which has even some goodies that you can win, so it might encourage you to pass by. But primarily, we provide what we call co-location. Our site looks like this in Namave. So we provide co-location as a service. Co-location is where you bring your equipment to our facility, we power it up, we cable it up for you, but you maintain the control and the running of your facility, of your equipment in your facility. So we don't actually keep your data for you or interfere with your data. We just provide you the environment. So you basically bring your own equipment, your own IT guys are the ones looking after it, and what our job is in that case is to just make sure that it's powered up. We also provide a service we call Cross Connect, and Cross Connect is ideally a way that we can allow you to connect to another customer. Now, we have customers who provide connectivity. We have customers who provide power. We have customers who provide cloud services. So what we do is we allow you to connect to people that you can work with. So if you're looking to connect maybe your head office to a branch office, then you will connect to that connectivity partner through our data center. If you want to connect to the internet exchange point, you can do the same thing. If you want to connect to maybe a payment platform or a fintech, you can do the same thing. So what we're actually building is an ecosystem, and the ecosystem is not just around IT, but around anyone who needs this kind of services. These are some of the images from the facility that just show you a little bit what we've done around the power, around the cooling, around the data hall, around the network operation center. And first of all, also you are welcome to visit us if you would like to come and have a data center tour. Several faces here have been with us. In terms of the people who can provide you connectivity in our facility, we have everyone basically who has connectivity in the country. MTN, Airtel, BCS, Liquid Rock Telecom, Uganda Telecom, C-Squared, NITA, CCOM, everyone can provide you connectivity as a solution within our facility, so you don't have to even get tied up with one provider. You can choose different people that you want to work with. What are we doing for the banking sector or the financial services sector is basically providing the infrastructure that can allow them to bring their own server infrastructure applications, and then of course they can host their banking services. Not to mention everything around banking and manufacturing. Even tourism these days is sitting on online platforms because the era of physical has gone in the past. Everything right now is moving into the virtual space. Yeah, so, I mean, we provide services directly for small needs and also for larger needs, depending on what you want. But as I mentioned, I would like to be able to utilize the opportunity of you guys coming to our booth in the exhibition area, and we can tell you a little bit more detail. I don't want to bog you down right now. But yeah, this was an opportunity to say thank you, the Uganda Bankers Association, for allowing us to partner with you yet again. And I'm happy to see a lot of the familiar faces from the banking sector and some of the people from the fintech and also the manufacturing sector. We'll be here for the next 2 days, and we want to basically introduce you guys to the world of IT and how IT enables businesses. Thank you, and bon appetit when it's lunchtime, yeah?
All right, ladies and gentlemen, I feel like I really shouldn't go up on stage for this part because the person who's coming next, you'll be delighted. Mr. Raj Kumar, who's CEO of Bank of Baroda, to give his closing remarks and probably bless us with the food. Just remind you before you walk off today, as Mr. Raj makes his way to the stage, ChargeCore, innovative. They give you booths where you can actually charge, or a charging center. In the exhibition side, when you go down there, you know, as you have your lunch break, you'll be able to charge any appliances you might have that, you know, ran out of battery as you're sitting here. Remember, ChargeCore when you go down to the exhibition side. Mr. Raj?
Thank you very much, Flavia. Now, time has come to extend appreciation and thanks to all the participants. So, Mr. Antigi Igo, Michael Ntigi Igo, Deputy Governor, Bank of Uganda. Permanent Secretary, Ministry of Trade, Industry, Cooperatives, Geraldine Sally. Mr. Hippolyte Fofak, Chief Economist and Director, Research and International Cooperation, Afri-Exim Bank. Mr. Saryar Ali, Country Manager, East Africa Operation, MasterCard. Executive Director, Uganda Manufacturers Association, UMA. Honorable Member of Parliaments present. Chairperson, Uganda Bankers Association, Sara Rapta. Chief Executives from commercial banks, MDIs and microcredit institutions, respected dignitaries, invitees, and participants who are physically present and joined the conference virtually. Ladies and gentlemen, all protocol observed. A very good afternoon to everyone. I'm very glad to get an opportunity to propose vote of thanks for this august and enlightened gathering. The day has been blessed with some of very insightful thoughts from events learned panelists. The welcome remarks by Madam Sara Rapta, Chairperson, Uganda Bankers Association, set the tone of the day. The purpose and usefulness of the 5th Annual Bankers Conference 2022 was gracefully highlighted and sense of direction for the day's activity was established. Remarks from the topic delivered by the Executive Director showcased the prudent efforts solicited by the manufacturing community from financial institutions and efforts which are needed to be embarked for proper channelization of resources to bridge the gap and accelerate the recovery post-COVID. Remarks from Madam Geraldine Sally underlined the expectation of the ministry and the conscious efforts being delivered by them to eradicate the gaps and nurture the bridging efforts for recovery in industries, more particularly manufacturing, tourism, and agribusiness. Mr. Ali from MasterCard has elaborated and explained that how MasterCard is partnering to bridging the gaps in the financial sectors and what MasterCard had taken the recent initiative to leverage the opportunities. Remarks from Honorable Governor Michael Ntigi Igo tinted on the importance of the topic and deliberated the significant contributions and financial sectors can make in taking the big leap for the revival of the economy and its underlying sectors. The keynote address delivered by Mr. Fofak showcased an erudite approach towards the importance of the topic and sessions to be deliberated for these 2 days of the conglomerate. He successfully demonstrated that how a financial institution can pillar the bridges that can lead to the recovery of the economy. My thanks goes to Mr. Paul Bushariji, who successfully moderated the session 1 on the multiple player role manufacturing plays in the promoting growth of SMEs, job creation, regional trade, and diversification and specific efficiency and funding challenges constituting this role. I request all enlightened panel members of panel 1 discussions, Mr. Moses Kagawa, Mr. Francis Kamuligawa, Richard Mubiru, and Executive Director, Uganda Investment Authority, to accept my gratitude for providing profuse and valuable thoughts toward the topic of discussion. They clearly pinpointed the relevancy of the subject in the present macroeconomic context. I'm sure that we all have been benefited with the insightful deliberations presented by the panel members. They beautifully explained the contribution of financial sector can make in providing resources at the disposal of SMEs, which shall create more job opportunities in the country. I thank Mr. David Ufungi, who meticulously moderated the second panel discussion, which highlighted the expectations from banking and other financial institutions in the growth of manufacturing sector and value chain financing. My sincere gratitude goes to Dr. Edward Isingoma, Mr. Richard Viragi, Mr. Jonan Kishaike, Mr. Anthony Kituka, who participated in the panel 2 discussion and eminently highlighted the painstaking trouble the manufacturing and related sectors industries have witnessed due to the catastrophes of the pandemic. They also explained the enormous contributions which the financial and banking industries can make towards overcoming the cycles of pandemic, and banking industries can make towards overcoming the cycles of the pandemic and enhancing the purchasing power. The discussions has also provided the end users enough food for through to comprehend and execute while creating professional landmarks. The success of the day 1 is also a testimony to tireless efforts being put by the UBA organizing committee under the leadership of Executive Director Mr. Wilbord of the event in coordinating and flawlessly organizing this function. At the outset, I also wish to convey my sincere appreciation to the sponsors of the event of day 1, MasterCard, Finca, AfriExim, ABI, BPC, Radisco, Rexio. Without their timely support, the organization of the event could not have achieved the gigantic scale. I also convey my thanks to all the members of Uganda Bankers Association and Uganda Institute of Banking and Finance for their support to cause of the banking fraternity and economy of the country. I wish to also thank Bank of Uganda, the Central Bank and Government of Republic of Uganda for their pinpoint focus on the revival of the economy and adding values to the life of the remotest inhabitant population. Last but not the least, I extend my appreciation to the management and staff members of Kampala Serena Hotel and the service provider for this digital video interface and social media platform for their seamless support in making the huge event possible for the day 1. Finally, we solicit your continued support and encouragement to march forward in the quest of knowledge and making a better tomorrow for all Ugandans. Thank you all again. Have a blessed day ahead. Thank you.
Thank you so much, Mr. Raj Kumar from Bank of Baroda. Those were closing remarks. Thank you so much. We do want to thank our panelists, the moderators, the writers, the partners, the sponsors, and everybody who's made today a big success. Tomorrow, the conversation will go around agribusiness and tourism. Make sure you're here. Our exhibition stalls are still open. We have ChargeCo who are ready to give you some charge for any of your appliances that might have run low. And for you to see that innovation, since we spoke about innovation today, I know I need to keep quiet because the stomachs are saying something totally different. Well, thank you. I'll be here tomorrow. Make sure you join us for that conversation. Our hashtag was BankingConf 2022. Again, our sponsors, Taraxio, Finca, BPC, ABI, Afrexim, and MasterCard. And to you for being very, very, very patient. For our partners, moderators, the writers, there's some gift, something nice that is packaged for you, and our ushers and the team will be ready to give it to you. But for now, allow me to say good afternoon. Enjoy your lunch. Enjoy your lunch. This is where you clap because you're happy. Have a good afternoon. See you tomorrow.